we think the Fed's in a good spot. We do think rate cuts are coming.
From a market perspective, a Fed is expected to start cutting. In my mind, that only happens if really bad things happen in the economy. And I don't see that.
Really, it looks like the inflation beast has been slayed.
The near term here, we've got everybody seems to be too happy.
If the market goes too far on its own, then the question will be, what more does the Fed need to do?
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
No doubt about it. The Fed will continue to be a big topic of discussion in 2024. Well, very good morning, everybody. From New York City for our audiences worldwide, this is Bloomberg Surveillance live on Bloomberg. I'm Carol Massar alongside Manus Cranny and Katie Greifeld. We are in for John, Tom, and Lisa, who are getting a little bit of a rest this week, although I guess they're getting ready to, like we all are, for conversations where the Fed is going to be, again, a big topic this year, this coming year. Liquidity, does it continue? This is all going to be around.
Yeah, I mean, if you look at that sort of last flurry into the last 5 days of last week before everybody sort of exited, you had this sort of momentum. The inflation data was good. The core PCE was like the final kind of like victory moment. Hurrah for the bulls. It was like
the Fed is saying we've done it.
Hallelujah. We got core PCE on the dip.
I got to say, the chart that I'm obsessed with, and I brought this up a lot on Friday, was you take a look at 10-year yields. It's been a round trip. We are pretty much right where we started the year, which I think speaks to the kind of year we've had overall. It feels like everything we were talking about this time last year went out the window, and we think about the movements that we've seen in the bond market really guiding everything. We're right where we started.
But what a long, strange trip it was, right, in terms of what we anticipated at the beginning of the year of 2023, what we had to go through when it came to the bond market, Fed expectations. You do wonder whether things start to calm down a little bit.
Well, of course, at the start of the year, there was the R word, the obsession with the R word, the recession which is probably a quiet recession, but it never really gripped us in terms of the unemployment numbers. You look at the positioning in the bond markets, and I think this is where the nuances begin to play out for the first quarter of next year. Positioning in the bond market going into this, you've got extreme positioning according to Citigroup. They are seeing what? I mean, bonds pulled it back. Bonds were supposed to be the nightmare trade again for the rest of this year, and they didn't. Right. They ended up delivering, U.S. bonds delivered a 3% return, but the positioning is extreme.
With some stomach-churning volatility at that. I mean, you think about...
And sometimes in a given day.
I know. 20 basis point swings in a single day for bonds. When it comes to the recession, the phrase that I found that I like is rolling recession. Maybe it didn't happen on an economy-wide level, but it feels like certain pockets, certain industries certainly felt the pinch.
And maybe that's why the Goldilocks economy week here, the conversation, once again, I tweeted out a picture of Goldilocks last week after some of those inflation numbers.
Like the cartoon character?
Yes, the cartoon. Thank you very much, Disney or whomever. But it's interesting that because of that rolling recession, where pockets of the economy start to slow down, but other parts are strong, that maybe creates that Goldilocks economy, that maybe the Fed really does engineer this.
Well, look, gas prices have dipped. Gas prices are important. Although mortgage rates, they are the next, that is the next issue. If the Fed delivers the 160 basis points of cuts that the market is baying for from them, what happens next to the housing market? I mean, what does it take to trigger 160 basis points of cuts? A soft landing and just behaved inflation? That's the moot in this market. Can you get 160 basis points of cuts without something more aggressive or harder happening to the economy?
That's the question that I love. Okay, 75 basis points, maybe that's just getting back to neutral. 150, 160 basis points of cut. That feels like a recession being priced in, but a lot of room for disappointment when you think about the gulf between the Fed and the market here.
All I'm going to say is, too, I feel like all of last year, just when we thought we understood the narrative, something happened, whether it was the regional banking crisis. I think about the Middle East, right? We had a bunch of headlines over the weekend and concerns about this crisis escalating. It's just a reminder that just when we think we figured out this market environment, Manus, that something happens that kind of changes that.
Well, there's two set pieces on this geopolitical board this morning. One is about the U.S. striking in Iraq. The other is, of course, what's happening in the Red Sea and the passage of ships. If you look at Javier Blas put out a tweet in terms of the number of ships that are diverted now away from the Red Sea is over 100. But then you look at Muller-Maersk, this is the second biggest container company in the world. They are going back in, and they're going back in with the protection of the United Forces that were set up to try try and keep this channel of global trade opening. But yet oil is fairly phlegmatic when it comes to its response to this news flow over the weekend.
I think that's so significant. We talk about the importance of supply chains. We've got a lot to get to. We do want to get to the market environment. No surprise, everybody. It's going to be a little quiet today, this week as well. And we're coming off, it was a little quiet on Friday ahead of the Christmas holiday, but the S&P 500 coming off an 8-week winning streak, longest in more than 5 years. So the question is, does it continue as we wrap up 2023 this year? S&P 500 futures, though, guys, look at it. Not even up about 0.2%. That's not a surprise. Euro dollar cross 110. We're looking at 10-year at 388. Hard to remember that when we were thinking about 6% on that 10-year earlier this year. And New York crude watching the energy markets because of some of the concerns out of the Middle East. And you've got crude, right? Kind of quiet this morning, which is a little bit of a surprise. 73.49 a barrel.
Yeah, it's been pretty amazing to watch crude. I mean, you think about just everything, all of the headwinds coming into this market, but still it's supply driven more than anything else, even amid that headline risk.
All right, we got a lot to talk about with David Sowerby, who is sitting by. He's managing director and portfolio manager over at Ancora. David, happy Christmas, Merry Christmas, happy holidays. So good to have you here. It does feel like we're going to be watching a lot of the same things in 2024, but let's talk 2023 and the recent market, not volatility, but risk on trade that we've seen. How do you explain it? Does it make sense? Is it fundamentally backed?
I think it's fundamentally backed. If you look at the micro and put the macro aside for a moment, companies are still generating above average cash flow margins. Their valuation on a free cash flow basis still sells, I think, at a reasonably attractive level. So the micro is a pretty good backdrop when, as you've discussed already this morning, more signs that maybe the Fed is going to be friendlier in 2024 from an interest rate perspective. And we're already seeing the effect of that with long bonds down 100 basis points. That's already acting indirectly as a Fed rate cut.
David, good morning to you. Happy holidays. You're the brave man that answered the call and said, yes, I'll get up for 6 a.m. in New York.
He had no wine at Christmas dinner last night.
Only for Bloomberg.
Look, good to have you with us. The other side of this sort of run-up that we've had in risk, in 10-year paper, in equities, is that equities and bonds are now fully priced on the expectation of 150, 160 basis points of cuts. And the road is one to disappointment. 388.55 double nickel is where we are on 10-year government bonds this morning. So are we fully juiced in equity and bonds? And is the road ahead going to be a little bit trickier than we all presume?
It's always going to be trickier. The rule of thumb in a single calendar year is it's football season. So bet the over or bet the under. That is, the S&P usually returns better than 13% in a calendar year or less than 6% per se. So we know 2023 was a bet the over year. I suspect next year it's going to be a bet the under year for the S&P 500, returns less than 6%. But where the news gets better is the average or median stock in the S&P 500 can be up meaningfully better than that because of the micro I referenced. Margins are still quite favorable. Valuations, you can still find 150 or better stocks in the S&P 500, I think, that trade at a pretty attractive valuation.
The one narrative that has come through over the past couple of months has been the amount of money stuck in money market funds, nearly $6 trillion in total, week after week, month after month. The flow show from Bank of America showed that. You've also got institutional money sitting on the side. Is that what puts a floor and delivers the minimum return that you've just discussed? Or can there be a new wave of capital deployed in 2024, perhaps that we're underassuming?
I think data is the plural of anecdote, and anecdotally, we're seeing more funds flow into stock ETFs in the last 4 weeks, particularly into the down and out small cap asset class. That will continue to play out next year. Specific to small caps, the median small cap company is going to grow its earnings 8 to 9% next year. That's probably as good as we're going to see in the S&P 500, when at the same time small caps are trading at their best valuation entry point since early 2001. I think we're going to see more money flow into the equity markets simply because those yields are going to keep coming down a little bit for money markets.
Let's talk a little bit more about money markets. That $6 trillion sitting in money markets right now, a lot of that coming in the past couple of years. A conversation that I've been having with people is how much of that actually belongs to risk assets, belongs to the equity markets, or whether or not really that has come at the expense of bank deposits, whether that's stickier money than is typically in money market funds. Where do you fall when it comes to the profile of that cash that's come into money market funds?
Well, you said it best. Let's call it all of the above. But I think so much of that did come after mid-March when people were worried about the banks. Banks were offering yields less than 1%. So the savvy investor in a higher interest rate world found its way into short-term paper that was yielding better than 5%. I think that was a good story in 2023. But I think for the investor who wants to get a better inflation-adjusted and after-tax rate of return, it's going to be right back into the opportunities in the U.S. equity market.
Well, let's talk more about those opportunities. Obviously, you're looking at some of these small caps here. And going through your notes, you have some specific stocks you point out, including Crane NXT. Only 4 analysts follow this stock, and apparently you too, David. What do you see in this company?
Well, with the backdrop being one of the best formulas are buying spinoffs. Just look at the Bloomberg spinoff index as proof of that over the long term. Crane NXT is a spinoff out of Crane, the industrial company. They make currency, U.S. and globally. They operate the machinery that makes currency that allows for lack of fraud. So we're seeing currency still growing, both here and abroad. That's where backlogs are up 80% for Crane NXT. So underfollowed spin-off company. That's always been a great formula. I'd add in there quickly on the staple side, a name like Kellanova, which is the spin-off out of Kellogg's, Cheez-Its, and Pringles, and Pop-Tarts, and Growth International.
So much for healthy eating, right? So much for that.
What about
supposed to be the trend
in
there.
moderation. Yeah. Day after Christmas. Let's call it in moderation as we get on that scale. But I think that's still a growth, and it's a spin-off from the larger Kellogg company, the food division. So I think that's always going to be a good formula. But as small caps do better next year, as well as some select large caps, there's a very good formula, spin-offs.
It's interesting. And I was looking at the weekly returns just last week. Small caps really outperformed up about 2.5%. Having said that, when you talked with Katie about Crane NXT, it's already up almost 70% this year, looking at a forward-looking PE of about 14. But you still see more room to run despite the gains because the fundamental story backs it, David.
Absolutely. And the simple fact that small caps have lagged materially. So whether it's Crane or other small caps, I think you're going to see much better performance out of small caps in 2024. It's not just talking your book. It goes back to they haven't traded at this type of relative valuation since 2001. When there's better support for earnings and cash flow, I think it's a good complement to your U.S. large cap allocation.
All right, we're going to leave it there. Hey, David, as always, you are certainly a friend to Bloomberg. We wish you a very, very happy new year and good to check in with you and talk about really the broadening out of the rally that we've seen, too. David Sowerby, of course, of Ancora, joining us there remotely. Having said that, I do wonder, guys, if we get another year, though, where everybody pushes back against growth, pushes back against buying the index, and yet that's where ultimately we see the gains, Katie.
It really feels like that was the story of 2023. And I know we've had this fantastic broadening since late April or so, but we'll see if that continues. Of course, you do have a friendlier Fed, as David Sowerby just told us. Whether that's enough, Manus, we'll find out.
Yeah, I think we're all going to probably suffer from that FOMO. I mean, you just see...
It's hard not to, right?
Well, you just see that rush 8 weeks in a row, week after week, and there wasn't really any breath in that equity rally at all. It was just a wall of money. The question is how supported is it by the institutions, or was it just all fast money? And I think that's a debate we'll find.
And I also do wonder on a name like Apple. We're looking at a headline this morning.
Yeah.
The U.S. Trade Office coming out and saying Apple did infringe 2 patents owned by Massimo and Suricor. We know that story was developing last week, halting the Apple Watch sales. So how does that affect some of these growth stories? I don't know.
Indeed. And then Japan also going to rein in Apple and Google. So a lot of tech conversations are had over the next 3 hours.
They certainly continue. Hey, guys, we're just getting started on this Tuesday. Coming up, though, at 7 a.m., Tom Tsouras of Strategas. You're watching and listening Bloomberg.
look back over the course of the year, it is really stunning how much progress the economy has made. Inflation's come down faster than even the more optimistic forecasts, and growth has remained very resilient along with a strong employment. If you recall, a year ago, the consensus projection was that getting inflation down would require a spike in unemployment and a recession.
All right, that, of course, was Lael Brainerd, National Economic Council Director, speaking on Friday. Welcome back, everybody, to Bloomberg Surveillance. Carol Massar, along with Katie Greifeld and Manus Cranny, in what is expected to be a quiet week, but it's not going to be a quiet year when it comes certainly to politics. And I do wonder, even that economic backdrop, you guys, how that helps, hurts when it comes to the November presidential elections, Katie?
Well, when it comes to President Joe Biden, I mean, the real bugaboo has been the fact that he can't seem to get people excited and engaged with Bidenomics. A lot of that has to come back to the inflation that we continue to talk about, even though the rate of growth has gone down dramatically. I mean, overall, prices, Manus, they're still super high compared to where we were just a couple of years ago.
Yeah, and look, and from the other side, you're going to have this lambasting of Bidenomics and the inflation narrative. Of course, what we're going to have is a great deal of politicization of the Fed. We're going to go into an election year. The market, I mean, Mohamed El-Erian, you know, as we know, Bloomberg opinion columnist, has berated the communication from the Fed and says the Fed has been backed into the corner. But there is going to be this debate now, if and when they pull the trigger on rate cuts and how seriously they do cut rates, how politicized are those rate cuts as they run closer to the election. I think that's going to be a part of the zeitgeist of 2024.
There's going to be a point where they're going to have to pull the cord and just say, maybe we've got to stop it because we're getting too close to that November election. Having said that, where are we on this Tuesday? Let's get a quick check on the markets. As we've been saying, no surprise, expected to be a little bit of a quiet day and a quiet week. We've got markets overseas that are closed. S&P 500 futures, which have had quite a run since the recent lows. 48.11 we're looking at, up about 0.1%. 110 on the euro-dollar cross. You've got that 10-year, 387, so it's just down, call it little change there.
You almost feel like ringing a bell for that, don't you? It's just like, no stopping it.
Like just put it in cement, right? Like, it's kind of shocking to see where we are. New York crude, though, also just a little bit lower. Having said that, I mentioned politics, and that is certainly going to be on everyone's mind this year. Matthew Bartlett is a principal at Darby Field Advisors, also has worked on various political campaigns for the GOP. Matthew, good to have you here. We've got a primary, the New Hampshire primary, coming up in January. So we're thinking about, let's talk about the Republicans first. Is it a lock for Donald Trump at this point, or do you seriously consider some of the other players?
Yeah, good morning, Carol. You know, I think you said it best. We're heading into an election year, but this race has been playing out in New Hampshire for more than a year. And as it gets colder out, as we get towards past the new year, there is a chance for significant volatility. This race, maybe on both sides, is primed for disruption. And you have some players that have been out there. Nikki Haley's been working hard. Ron DeSantis has certainly been, some of the activists' attention. But right now, Donald Trump continues to be a dominant force, and certainly will be until he might not be.
Matthew, I was quite surprised when I was reading through your notes. You say, good morning, it's Manus, by the way. You say Trump is at 50%, not 80%, and he should be more significantly ahead. So what does that do? Are we all myopically just absorbing the media going, there is no option to Trump? Or does this primary allow us to understand where Haley and DeSantis sit or have the potential to challenge?
Yeah, excellent point. Let's remember, this is not a national race for president. These are state-by-state contests. And right now, Iowa is certainly, we've seen activity and will be underway. And then comes New Hampshire. After New Hampshire will be Nevada and then South Carolina. So these contests, you really need to pay attention to the polls in the early states as opposed to the national polls. The national polls tend to be lagging, and maybe the early state polls are much more of an indicator poll. So right now, New Hampshire, if you look at the polling, as you just mentioned, Donald Trump, the former president, really the political identity for much of the Republican base for the better part of a decade, he is polling under 50%. That's a significant opportunity for someone to come out and challenge him for the nomination. Right now, that person, at least in New Hampshire, that is Nikki Haley. She has the endorsement of the very popular Governor Chris Sununu. Again, New Hampshire is a purple state. It is a swing state, a Democrat delegation, and a very popular Republican governor. She earned his endorsement. So far, that's helped catapult her, to the stratosphere, where this actually could be a very competitive race in New Hampshire.
Well, Matthew, let's talk about one specific poll. Of course, I'm talking to the December 21st poll that was released by the American Research Group. That caught a lot of attention since it showed that Haley was just 4 points behind Donald Trump at about 29%. Trump, of course, at 33%. Donald Trump, of course, basically called that poll fake news. But when you weigh together all of the polling coming out, when it comes to New Hampshire, how close is the gap between these two?
Unclear, right? Polls are important. Polls show momentum. Polls indicate movement around a campaign and a candidate right now. But as you said, this race is going to get much more real after the new year, where voters really pay attention, where there is that real volatility, as we see in the markets almost every day. You will see that in New Hampshire. You will see that in Iowa, and that's where Nikki Haley, it appears, is in a position to really capture the attention of the party, starting in New Hampshire and possibly going down to South Carolina, her home state, and making this, much more of a national race moving forward.
Hey, Matthew, one thing I want to ask you. You resigned in protest from the U.S. State Department. You were appointed by Donald Trump. What would another Trump White House mean for Americans in the United States? Do you think having a second term for Donald Trump is a good thing for the United States of America, and not only its role here domestically, but on the global stage with so many global things going on?
Yeah, Carol, that's a hard one, right? I resigned January 6th. Very hard day here in this town. Very easy decision in my life. But moving forward, I know that there are many people across the country, even around the world, that certainly have frustrations, whether it's economically, whether it's globally. But in terms of a second Donald Trump presidency, boy, I think most people across the country are looking at maybe better options here in this country, whether it's Republican or Democrat. If you look at the polling, it appears as if Donald Trump and potentially Joe Biden are on course to get their own nominations, and it appears as if the country really wants a different option. So that's why this race right now, it is so primed for disruption. It is quite possible that it starts in my home state of New Hampshire, and where it goes then will be up to the voters.
Matthew, just before we let you go, I'm just curious to get your take. Obviously, the Colorado, let me just read to you what Lindsey Graham said about the Colorado ruling. Colorado is chilling to me. It would set up a politicization of the presidential race. It would be bad for the country. Now, let's work on the base assumption. The Supreme Court finds in favor of Trump. He goes on the ballot, and that continues. Has Colorado just simply emboldened and double emboldened the Trumponian base?
Absolutely. What do they do better than any other campaign or candidate maybe in history? Play the victim. Manipulate a situation where it is completely because of his own actions, because of the choices and decisions that he has done and undertaken, whether as president or try to remain as president, and then to somehow play the victim card. It is unbelievable that this continues to happen, and it is very unfortunate that in this case you had a court ruling which will probably, most experts, Republican, nonpartisan, believe that this will be overturned. But again, the supercharging of the base, the grievances, the you are the victim, this does nothing but play into that. But
Right.
We'll see, again, as things turn the corner here in the new year, as this race gets serious, and there are many more potentially better options presented to the voters.
Matthew, really quickly, 30 seconds. Is Donald Trump still really controlling the purse strings, if you will, of the GOP party?
Yeah, I mean, listen, there's, the whole consultant class, and he's been in a fight with Ted Cruz's consultant, Jeff Rowe, and they've gone back and forth as to who should be in charge of Senate races moving forward. But yeah, he is the big dog, the former president, and that comes with not just, support from the base, but influence here in this town, whether it's debt ceiling negotiations, shutdown negotiations, the new speaker, as well as races across the country.
All right, we got to run. Hey, Matthew, thank you so much. Matthew Bartlett of Darby Field Advisors, thank you so much. I could talk all day about politics because I feel like...
Well, you're going to have the whole of 2024 to do it, Carol, so don't worry about it. You'll be there.
We're also going to be talking probably a lot about big tech, which is why we have a great guest coming up. Coming up at 6:45 a.m., Dan Ives of Wedbush likes Apple just a little bit. Yeah. Could it be a $4 trillion market cap someday?
We'll find out.
We'll find out. This is Bloomberg. For our audience worldwide, very good morning, everybody. This is Bloomberg Surveillance live on Bloomberg alongside Manus Cranny and Katie Greifeld. I'm Carol Massar. We're in for John, Tom, and Lisa. Quick check on the markets. It's going to be the final week, trading week of 2023. Yay!
We did it.
S&P 500 futures just up about 0.1%. Not much happening this week. We do have some auctions. We have a little bit of, I think, data flow, but not much. Some markets closed overseas. NASDAQ 100 futures, really the outperformer, up 1% last week. We're looking at the NASDAQ 100 futures up about 0.2%, 31 points to the upside. Russell 2000, the outperformer last week. I was kind of surprised, guys. Up 2.5% last week, up another 0.4%. So really outperforming. It's like investors have all of a sudden got the memo that, hey, guys, you know.
And it feels like you're still seeing big moves when it comes to the small caps. Not so much when it comes to the S&P 500. Quiet, but very, very consistent.
Yeah, very consistent. Treasuries, consistent. Feels like they've settled down a little bit more consistent in terms of the trade.
Don't jinx
it. Fingers crossed, toes are crossed. U.S. 2-year, 433, just up a hair. U.S. 10-year, we're looking at 388, and the 30-year, 403. Let's flip it on over to what's going on in the currency market this Tuesday, and we're looking at the euro versus the U.S. greenback. You can see just up slight, 110. I was just over in Europe. I'm really familiar doing all those exchange, finding out where I could get my deals. All right, let's get to, that's your market setup on this Tuesday. Let's get to under surveillance. What's in some of the headlines on this Tuesday? A serious one and a reminder of the tensions overseas, the war overseas. The U.S. launching strikes on 3 installations in Iraq, targeting what it says is an Iran-backed terrorist group accused of a series of attacks on American personnel. The U.S. saying the strikes destroyed the targeted facilities, while Iraq condemned the strikes, saying the U.S. had targeted Iraqi military sites and then a member of the country's armed forces was killed. All right, guys, this is a reminder. I feel like reading in that this is something that we're going to be dealing with in 2024, even though there's so much pressure to put an end to this war.
Yeah, I mean, this is everything that the United States and the rest of those coalition of the West don't want to see, which is an expansion of this conflict, which is the Hamas-Israel war, materially beyond borders, whether it's to the Lebanon Hezbollah or in this case, dealing with Iraq. It's a widening of the conflagration, and that is absolutely not what this White House wants to see. Let's see where the rhetoric goes in terms of off-ramps, de-escalation. It doesn't seem as if we're any closer to that from Netanyahu at the moment. And then, of course, you've got the attacks in the Red Sea.
Yeah, and a reminder that investors have to watch things domestically, but also what's going on overseas. And that includes China softening its stance on gaming, the back and forth of Chinese policy. This is coming just 1 week after moves to tighten restrictions led to an $80 billion rout. The country approving 105 domestic games, including names from Tencent and NetEase. You know them well. 2 of the companies hardest hit by Beijing's new rules. Last week, China's top gaming regulator announced new rules to limit the development of online games, including a cap on spending by players. And Katie, this is the back and forth in terms of investors trying to figure out where exactly China lies, especially when it comes to publicly traded entities and really, you know, the business environment.
Exactly. I mean, when these rules came down, or news of them came down last week, the question was, is this another 2021 episode? And you talk about the back and forth when it comes to policy, what that means for investor sentiment, what it means for investor confidence. Obviously, it erodes that. And you've seen that just in the performance this year. You think about it's been a great year for EM overall, EM ex China. Then you take a look at China and didn't quite work out. That was one of the big consensus bets coming into this year.
Always seems like it's its own story, right, when it comes to so many things. All right, that's some of the serious stories. We got something a little bit more fun for you. Shares of Manchester United rising this morning after billionaire Jim Ratcliffe completed his purchase of a stake in the English football club. Ratcliffe paying $1.3 billion for a 25% stake in the club and saying, quote, "Our shared ambition is clear. We all want to see Manchester United back where we belong at the very top of English, European, and world football." Having just watched Beckham, I feel like I'm an expert on
You're omniscient now.
Tell us more.
No, I'm not. What do you make?
Well, it was a battle.
Since you're from London, I've got to ask you.
Since I'm an Irishman from London, I think it's a battle royal between the Qataris. The Qataris lost out in this bid. Sheikh Jassim, he withdrew his bid. The Qataris were going hard at it. Everybody thought the Qataris would pay $6 billion. Jim Ratcliffe is he's like a British institution, really. He's a billionaire. He runs a massive chemicals company. He's going to put $300 million into Manchester United, and he gets 2 seats on the board. So I'd imagine from the fans' point of view, because there is a lot of angst in British football, in terms of who invests and who owns these football clubs and where they're going. And Manchester United fans, they're a pretty special group. I know them well when I see them at Chelsea.
Yeah, well, didn't Ratcliffe try to buy Chelsea as well? He seems like a man who just wants to buy things.
Well, wait, a billionaire who likes sports? Wait, when does that ever happen?
That reminds you of the whole of Saudi Arabia.
Exactly.
Okay, well, let's leave the sport for a moment. Let's talk tech. Companies, Google, Amazon, have had years of where they're promising the future will be filled with package deliveries falling safely from the sky. A startup company called Zipline might be the first to make the future of that widespread promise a reality. Bloomberg's Emily Chang takes a look at the potential of drone deliveries ready for takeoff.
I think so many technology companies are trying to solve problems of people who live in like a few specific cities of this particular country, when in reality, building the future that we want or that we'd be proud to hand to our kids involves humanity solving problems at global scale.
Right.
This is Zipline Drone Delivery. The startup, founded in 2014, helped build hype for a future filled with packages falling conveniently from the sky. As that future becomes more of a reality, Zipline will have to compete with the likes of Amazon's Prime Air.
Let me show you something.
Oh my God.
Remember when Jeff Bezos unveiled an octocopter on 60 Minutes?
These are octocopters.
That was a decade ago. No octocopters yet, but Amazon is making slow progress, and Alphabet's Wing is getting off the ground as well.
Thank you for coming.
Good to see you. It's good to see you again. It's been a while.
Welcome to Zipline. We serve 8 countries. Today we serve about 3,500 hospitals and health facilities globally. It's become the largest commercial autonomous system on Earth.
Zipline honed its technology first in Rwanda, delivering blood, vaccines, and other medical supplies, especially to rural areas that were previously poorly served by land.
Does that give you chills that you guys are out there saving lives?
It definitely never gets old, especially when we get to go spend time with doctors, meet patients who are benefiting from the system, and it's been really cool to see the system scale.
Can you show us how the magic happens?
Yeah, let's do it. So this is Zipline's main manufacturing area. Zipline has 2 products today. Platform 1 is really focused on enterprise delivery. Platform 2, we're launching with customers in a few months.
So that's the one that's going to be delivering all the packages to my door.
Yep, exactly. We're a pretty full stack company. We're building LRUs, or line replaceable units, so basically the sub-assemblies of the aircraft.
It all happens here.
Yeah. You can think of this as like the ears of the aircraft. So we're passing a huge amount of air through here. It's like a really quiet wind tunnel. This is the Paraland tube. If we're encountering such insane weather conditions, or there's like systematic failure throughout the entire aircraft and across multiple levels of redundancy, then we can deploy the parachute so we can bring the aircraft gently to the ground. This is the reason that through 50 million commercial autonomous miles, Zipline has had 0 human safety incidents. See these 2 holes? You're gonna line those up with those 2.
I think I can do that.
Nice, you did it. Good job.
Oh. Not heavy at all.
Yeah, or you're really strong. This is the advantage of carbon fiber materials. You can design something that's really strong. It's designed to go up to about 3 Gs of load. Where we are now, we call it Nest Zero. This is actually the first test site.
What's the grand plan?
When we started building Zipline, the more we thought about logistics, the more we realized global logistics really only does a good job of serving people in the golden billion. So, the richest billion people on Earth, your access is probably okay. But for the 7 billion people who don't fall into that category, your access either sucks or is non-existent. And as a result of that, 5.5 million kids under the age of 5 lose their lives every year due to lack of access to basic medical products. From a mission perspective, what's exciting to us about building an automated logistics system is that will be the first logistics system that serves all people equally. It will enable us to transition logistics to zero emission. It'll also enable universal access to a lot of different products, including life-saving products.
So not to overly simplify it, but is it the goal to be like a modern-day UPS or FedEx, or is this something bigger?
I actually think the opportunity to build a system that is 10 times faster, half the cost, zero emission, and broadly available to every human on Earth is probably like 10 times or larger. Emily, this is Fabiola.
Hi. I started at Zipline 4 years and a few months.
And it was Rwanda 1?
Yes.
It's basically members of the Rwanda and Ghana flight operations teams now having to train all of our US team members on how to do this at scale.
Any matters? Welcome to the 1, 2, 3, 3, 2, 1.
All right. That's amazing.
Ton of t-shirts.
Oh, t-shirts, guys.
And water.
So prepared. So is the goal to deliver everything from blood to vaccines to my Kleenex and sushi?
I mean, it turns out that our customers want everything. In the US, a good analogy, with Walmart, we had initially planned to launch with them around their pharmacy business. They're one of the largest pharmacies in the US. We launched delivering healthcare products, but very rapidly it was clear that customers wanted to order everything. And so today we deliver like 24,000 of the 29,000 SKUs in the store that we're attached to.
You do have competition, Amazon Prime Air, Alphabet's Wing. What makes you think you can lead this market?
I think there are a lot of big companies with kind of infinite resources talking about this market, but talk and walk are different things. We are the largest commercial autonomous system on Earth of any kind, ground or air. So
compared to Amazon,
a lot less. You'll have to ask them that question.
Zipline's first delivery drones were all about getting supplies to places with enough space to drop packages from midair to the ground. The company's platform, too, is all about precision and reaching more dense urban areas.
One of the most important things about making the overall system work is how do we integrate with all the different companies that want to take advantage of this to essentially enable teleportation from their businesses or warehouses or stores directly to a home. Zipline can basically show up and install a magical portal in your wall. That's kind of how we talk about it.
It's a Harry Potter door.
Yeah, or I think it was like Rick and Morty door, but you can basically choose what you want to load.
Okay.
Do you have any preferences?
I mean, pizza and coffee.
Pizza and coffee? Okay.
Everyone has to have pizza and coffee, right?
So I'll put the pizza in here and you can do the coffee.
Okay. I mean, is this gonna spill in there? Okay. All right. There you go.
So you just teleported something via Zipline. That's it.
Pretty cool.
We need to be able to deliver silently with dinner plate level accuracy. This is the only thing that's coming close to you, your family, your house. It's really cute. It's not making very much noise. It's totally safe.
What's going to happen to the UPS guy? I mean, what about jobs?
Any new technology, there's always this worry that it's going to put people out of jobs. So I think the reality is we're in a world where unemployment is, the lowest basically it has been over the last 30 years. Generally, I think there are not enough humans to do the work and labor that we want done to live abundant, rich lives.
And you can find more stories from Bloomberg Originals streaming online and on the Bloomberg app.
Can you share what you just said while we were watching the tape?
Where I'm from or on the tape?
No. But what you said about cities versus...
I think I grew up in the countryside, when I was very, very young. Obviously lived in 2-3 major cities over my life. And you get caught in this myopia of how can you have delivery from drones, etc. But you just heard there, in terms of the capacity for this kind of delivery mechanism, it's a bit like bringing internet to the parts of Africa. So this is about billions of people accepting new deliveries for health.
Well, I wonder if our next guest is going to have something to say about drone delivery. He certainly is all in when it comes to technology. He's got a good forecast, bullish forecast, surprise on Apple, very upbeat about 2024. Dan Ives is coming up next. Of course, of Wedbush. He's going to talk about that bullish tech outlook for 2024. This is Bloomberg.
This is not an accidental infringement. This is a deliberate taking of our intellectual property. Apple's internal documents that we saw in court showed that they knew their product wasn't good enough to be used medically. There needs to be an honest dialogue. There needs to be an apology. These guys have been caught with their hands in the cookie jar, and instead of being embarrassed and doing the right thing, They're blaming everybody and they're fighting everybody.
All right, that was Joe Chiani, CEO of Massimo. It's the company at the center of Apple's watch ban after the International Trade Commission found Apple infringed on patents from Massimo. The USTR now saying 2 patents were infringed, including the one from that company. So great setup to see what Dan Ives, who definitely likes Apple, see what he has to say. He's senior equity analyst at Wedbush, joining Katie, Manus, and myself here in studio. Great to have you here.
Great to be here.
Happy holidays.
You too. Great to be here.
Is it going to be a happy year for Apple? It feels like it's going to get off to a rough start.
I think it's time to get out the popcorn because, in my opinion, this is the next stage of, I think, the growth phase in Cupertino. And I think, look, if you look what's happened.
How do you factor in this kind of stuff? I can't buy a watch. I need a new watch, and I can't buy it right now.
Look, we're talking less than 1% of disruption from Apple Watch, in terms of in the actual quarter. And I think, look, it just speaks to they're going to have patent issues like this on healthcare. But there's a renaissance of growth on iPhone units, services, double digits. And that's why I think a lot of the bears right now, they're deep in those caves in hibernation mode. I think a year from now, we have a $4 trillion market cap on Apple.
You say the bears had a great fictional story, okay?
A Netflix fictional.
A Netflix fictional story. We all want to be in it.
Not Apple Plus?
I gotta hand it to you. This shirt just screams, full of confidence, full of vigor. But you look at the China story. So make sense of this for us. How do you get to $4 trillion when you still got the government pushing back against Apple products? It was a headline just in December. I mean, is that myth or is that a headwind?
I think it's a headwind, and ultimately my view in terms of China is that I'm not saying it's roses and champagne in Beijing with Apple, but we are seeing growth, and that's something we've seen come out of Asia checks even over the last week, because you have 100 million iPhones in China in the window of an upgrade opportunity. As those upgrade, and look, for Huawei, it's a good phone, but realistically, it's an iPhone 12. I'm saying from an actual functionality perspective. So I do think that it's a headwind they have to contend with, but it is the hearts and lungs of the Apple story. And that's why a lot of the bears at 500 billion, a trillion, trillion and a half, 2 trillion.
Well, they're whipped now, aren't they?
It's all about the China.
3 trillion now.
It's all 3 trillion, I think, going to 4 trillion. It's always about that big bad wolf, the China story. And the actuality, China has actually been fueling the engine.
Well, let's talk about what the bears are saying right now, because they're saying, you think about in terms of the product lineup, that Apple really hasn't had a hit since the AirPods, and that was all the way back in 2016. So you talk about this new growth, but from the product lineup, where is that going to come from?
Well, first off, the install base, it's unparalleled. It's the best install base in the world. So just from an install base perspective, you have 250 million iPhones in a window of an upgrade opportunity. I think that's why iPhone 15 so far, Christmas came early, a strong holiday season. But for 2024, and Gurman's talked about this as well, I believe you're going to have not just new phones that come out from an iPhone 16, but we believe you're going to have the iPhone App Store, which is going to be an AI app store focused on AI apps. That's going to be something that's going to be incremental for services. And I think that's very important. You combine it with Vision Pro, and we believe more and more products coming out, they flex the muscles.
Dan, is there a bearish story, though, on Apple? I mean, I think if Tom Keene was here, and I know this is how we feel, we are an Apple family. And when somebody goes to buy something, like, no, sorry, you can't do that. It's got to be an Apple product, because that's been our infrastructure. That's our network.
No green text bubbles, okay? None of that.
Exactly. Although there's an app that I think can pull people. But that installed base, I'm looking at, 2024 revenue estimate of $397 billion.
Sure.
Like, every time the Apple numbers cross, they're off the charts. Even if the growth isn't significant, there's still that installed base is enough to keep a lot of momentum going.
And if Keene was here, would he be focused on? And I think
he kind of is. We just have him under the table.
Keene's here, just like Matt.
I'm an incarnation of Tom Keene. This is the hologram. I am Keene hologram.
It's an AI. It's AI generated.
Good morning.
But is there a bearish story for Apple?
But look, realistically, it's about value. Look, if you look at valuation, you look at the cash flow generation of Apple that we're going to see over the coming years. The EBITDA margins are expanding. Now, I think the bear story, look, a lot of the bears, they just look at their spreadsheets on Park Ave and in their tower saying this is an expensive stock.
So you don't have a bear story for Apple at all?
Because to me, the bear story, it's valuation, it's China, and I think at that point, it's a headwind, but it's more fictional Netflix story than reality that's going to hurt them. And then it's just more competition. But it comes down to valuation. And that's why this year, I think the bears, they focus so much on valuation instead of the actual underlying growth story that's happening not just for Apple, but we believe it's the start of a new tech bull market for tech.
I mean, and this is your thesis for next year, which is about, 2023 was a year in which every time we saw an AI story evolve, Microsoft.
Wait, we were talking about AI this year?
Well, just a little.
AI and Ozempic. Really.
But if you didn't have yeah, I know. So I get tempted by Ozempic rather than the treadmill. But on a slightly more serious note, cloud and AI have been the dominant forces, as well as balance sheets in tech. I put those three together, and let's just put Apple aside for a moment. Cloud and AI. How do I disaggregate who's going to perform well in this? What's going to make a cloud A grade and an AI A grade stock?
Yeah, and I think you hit on what's really a key point. If you look at what's happened with Nadella and Redmond at the top of that mountain from a cloud perspective, now this is more monetization for the hyperscale players, for Microsoft, for Amazon, for Google. We believe for every $100 of cloud spend the last 4 or 5 years, there's 35 to 40 incremental AI spend. That's why I'd say when you look at Microsoft, you look at Google, this is going to be just a new frontier of growth. And then, of course, you have the godfather of AI, Jensen, NVIDIA. This is really just starting what we view as a 1995 moment.
The godfather of AI.
Look, Jensen's
top
the godfather.
performing stock in the S&P 500.
There you go.
But it's the biggest tech transformation in 30 years. Haven't seen it since 1995, start of the internet. And we believe this is actually the beginning of the next phase of this bull market.
I just want to know, are there a million AI ETFs that have all of a sudden come on?
You know,
watch that market, so...
there's a few dozen that were launched way before we started talking about AI around this time last year. But I do want to switch gears here and talk about EV demand, because this has been one of the stories that's really emerged. That it just feels like all of these automakers really miscalculated how much demand there would be for EVs. And now you're seeing those production targets get cut. How does that factor into how you're thinking about Tesla? Is that a bear case for Tesla, or does Tesla just command more of maybe a shrinking pie?
Yeah, Kate, I think that's a great point. Look, right now it's Tesla's world, everyone else paying rent when it comes to electric vehicles. And I think they're doubling down. You look what's happened in Detroit, GM, Ford actually peeling back a little from electric vehicles, some of the foreign automakers. Look, demand's definitely softened. Price wars have come through, but a lot of those storms have now passed. I think for Tesla specifically, unit volume looks strong in China. I think there's going to be a record quarter for China, in terms of Q4. You go into next year, I think demand actually starts to accelerate a bit relative to where people thought. I think for the overall industry, it's still a massive transformation, but now you're starting to maybe peel back a bit in terms of, okay, this is not going to 40% penetration, maybe it's 25, 30.
Dan, 30 seconds. China is the rallying cry of the bears when it comes to Apple. So, too, when it comes to Tesla. You think about all those Chinese EV makers. How does Tesla compete overseas?
They've done it. I think a lot of the price war, this was a poker move for the ages by Musk. Cut prices, focus on units. And that's why right now this has been flex the muscles in Beijing for not just Tesla, but of course for Apple, despite bear noise.
Before we started, we showed a piece on drones. Just real quickly, 25 seconds. Is there a drone play for you? All of the company, Amazon's in it, Walmart's, everybody's in it, and there's individual startups.
Yeah, look, I think that's past. I remember being a CES years ago.
You don't buy it then?
Fun. Yeah, I think that's. Look, that's why you have to separate.
Manus is like, yes.
No, but you separate hype from the reality. There's parts of that market that are growth.
Yeah.
But you look at AI, this is the Super Bowl in terms of tech market.
We're going to have a bull tech market in 2025, too?
Well, I think this bull tech market goes, we believe, for another 2 years. That's why right now it's getting the popcorn out.
Wow. That's a lot of popcorn. All right. Always fun to talk with you.
Yeah, great. Thanks for having me.
So appreciate it. Thanks for coming in the studio. Happy New Year. Dan Ives,
too.
of course, of Wedbush. Check out his research and, of course, his calls on things like Apple and just really the tech market overall. Hey, coming up next, Tom Tsouras of Strategas. He will be our guest. This on a day where it's pretty quiet in the market front. No surprise. We're just counting down the last 5 days of 2023. Folks, Katie, Manny, and me coming back. This is Bloomberg.
We think the Fed's in a good spot. We do think rate cuts are coming.
From a market perspective, a Fed is expected to start cutting. In my mind, that only happens if really bad things happen in the economy. And I don't see that.
Really, it looks like the inflation beast has been slayed.
The near term here, we've got everybody seems to be too happy.
If the market goes too far on its own, then the question will be, what more does the Fed need to do?
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City, for our global audience worldwide, a very good morning. It is Bloomberg Surveillance live on Bloomberg TV and Radio, alongside Carol Massar, Katie Greifeld, and myself, Manus Cranny. Your usual triptych on vacation somewhere, resting well after a long year and preparing for 2024. Good morning, ladies. Happy holidays. Is it going to be a full Monty of risk this week? That's the question. You look at the PCE on Friday, set us up beautifully for a home run in bonds. Risk on, good morning.
Good morning, good morning. I mean, risk on, it certainly has felt that way. And I do wonder in this quiet week, right, we don't expect maybe a lot of volume, a ton of activity. But I think about the week of even Thanksgiving where we thought it's going to be a quiet week and then things started happening. And I do wonder, is there any surprises, Katie, that might hit
hopefully
us?
We don't end up eating crow by the end of the week because there's a whole ton of news. But you think about the potential inputs. There's no earnings this week, thankfully, or none of any significance. No real economic.
Love earnings. It's just around the corner.
Earnings season, it never truly ends. But maybe this week we can finally put a pin in it. Of course, we could see some drama when it comes to the price action. Think about that low liquidity. We'll see actually what happens. But it does matter when you think about this weekly gain streak that we have built up on the S&P 500. Whether it continues or whether it breaks, that could be the one real newsbreaker that we get.
I mean, we've had 8 weeks of gains. We just had a great conversation with Wedbush there on tech, all things tech, and the evangelist call of $4 trillion for Apple from Wedbush. But when you look at the Magnificent Seven relative to the laggards, I mean, this equity market, does it need 160 basis points of cuts, which is what the market is baying for, to really push it ahead? That's the question that goes through my mind.
I keep thinking about the L word. That's what I tweeted out on it. And it's maybe not what you think. It's not love. It's not something else. But I think about liquidity and how much of the liquidity story, whether it's with investors, whether it's with companies, whether it's with shoppers, retailers. I'm curious what kind of shopping we might see kind of post-holiday.
Did you help the shopping when you were away?
A little.
She helped global shopping. She didn't help American shopping.
John,
the global economy.
I hope John isn't watching right now.
Okay.
Did no shopping, just did a lot of eating.
Well, happy holidays to everybody. It's the 26th. How is risk looking this morning? Equities had an 8-week winning streak this morning. Let's just check in. We've got U.S. equities a little bit higher this morning. This is what we got for you, up 0.1% on S&P 500. 8 weeks of gains. Euro dollar. Will the ECB cut ahead of the Fed? That is the mood in the market. 60% probability of a rate cut from the ECB in March. How much will the Fed do? 10-year yields, 388. I mean, this is what you call round trip united from the start of 2023 to where we're going to close.
It actually
out.
turned out to be the year of the bonds, but it was a tough one.
Yeah, I mean, we managed to deliver, 3% return year to date. We are at extreme positioning. Crude is flat, despite the military movement by the U.S. Against some targets in Iraq. Let's bring in Tom Tizarius. He is the head of fixed income research at Strategas, a Baird company. Good morning. Good to see you. Happy holidays.
Yeah, happy holidays.
So the U.S. bond market pulled it back from the jaws of defeat, delivered a 3% return. So does that set me up for a more magnificent 2024 or 388? Am I all priced in for 160 basis points of cuts? My run is done. Good morning.
Well, it's going to depend on whether we have a recession next year. And to tell you the truth, that is very hard to predict at this point in time because Washington, D.C. has decided that they're going to run this U.S. economy at full employment at all cost, which means it's going to be very difficult to get the consumer to pull back, particularly in the second half of the year. So we have a seasonal weak spot coming in the next few months, we'll say late January to April, where the U.S. could dip into a recession, albeit very shallow. If that's the case, then expect those rate cuts to materialize and the bond market to push yields lower. If that does not happen, that is, you do not have that seasonal weak spot transition into a rise in unemployment, it's going to be hard for the bond market to rally further from here.
Okay, I like what you say. They're going to run this economy at full speed as much as they can. What does that mean? I mean, what are the additional risks? One of the big debates that we were having before Christmas was about issuance and about indigestion in the bond market. So let's just square that away. We didn't get indigestion, really, on these bond auctions at the back end of the year. What's my risk in 2024 of indigestion?
Very high, but it's going to depend on what the Fed does. And because of that, I do believe 2024 is going to be the year that we have a very serious discussion in the financial markets about the Federal Reserve's credibility as an independent entity. Because if you look at the economy coming into 2024, it's still in a really decent spot. The unemployment rate is very low. It's hard to justify rate cuts at this point in time, certainly by March. Now, with that said, the market's pricing in 150 basis points of rate cuts here.
Feels too aggressive to you?
Too aggressive at full employment, absolutely.
Yeah.
Maybe 50, maybe 75 at full employment just to kind of fine-tune monetary policy. But 150, that's a very steep amount of cuts for something that is otherwise, as of right now, not a recession.
Tom, I feel like one of our favorite drinking games of the year was data dependent. Like, how many times we heard the Fed remind us, no matter what the narrative was, we're watching the data points. Even with what the market's expecting, a pretty aggressive Fed moving to cut rates, do we need to watch those data points very closely?
We do, and I would continue to watch wages, because this is the one I've always said average hourly earnings or employment cost index are the most important ones. Obviously, CPI and PCE are going to tell us whether the Fed has room to cut, but wages are going to tell us whether CPI or inflation are going to reaccelerate once those cuts hit. And here's the important point. Wages are growing at 4%. If the Fed's target is 2%, how are you going to stay there if rate cuts begin to culminate? How are you going to stay at 2% if wages are pulling inflation higher? Productivity has to be rough algebra 2%. I don't see that right now.
It's interesting. So then what worries you in terms of the economic story? Is it that we're all just expecting a much more aggressive Fed? What is it? Is it the expectation or what?
So I've got two worries going into 2024. One is the consumer is running at exhaustion, building up enormous amounts of credit card debt, and we're seeing bigger and bigger seasonal pullbacks. Oddly enough, in January, February, March, and again, we'll see them in September and October. So the consumer's binging from May to August, and then binging again from Halloween until New Year's. And then every 6 months, the pullback gets bigger and bigger. So patching that over with Band-Aid stimulus is require more and more stimulus. But the problem with that is you're keeping the economy at full employment artificially, and that means structurally inflation is going to continue to be elevated.
I want to actually go back to the politics of the Fed and this discussion that could be coming when it comes to the independence of the Fed, because you think about, the Fed cutting by March. In your view, that's not justified.
Is the Fed really political, or is it just a case it's got to do something?
Well, I mean, you think about the argument that they're making, that they basically want to get out of restricted territory, that this isn't cutting to ease necessarily. It's just to make things a little bit less restrictive, get closer to neutral. Do you not buy that argument?
Well, neutral might be 5% Fed funds rate, might be 475, it's not 350. That's the problem. Why is the bond market or the futures market pricing in such an extreme amount of rate cuts starting no later than March, when the economy and the equity markets, for example, are all projecting...
Could be a long variable lag eventually arrives.
Yeah, so something doesn't add up there, and I think the futures markets are starting to question the credibility of the Fed, and they're seeing, in particular, the Treasury is going to have a huge liquidity hiccup in the middle portion of the year if the Fed has not cut and has not stopped balance sheet reduction. So if you look out to June, you say rate cuts need to commence before then to help the Treasury.
I'm glad you brought up the balance sheet, because I feel like, we don't talk about it enough. And if we enter into a situation where the Fed is cutting rates, that their justification is that we're just getting out of ultra restrictive territory here, we can continue to run off the balance sheet. What does that mean for the bond market? How does the Fed message that, and how is that actually received by the market? Because, I mean, at first glance, that would appear to be the Fed acting at, opposite ends.
Well, this is going to be very difficult for the Fed to deliver on this politically, optically. It's going to look like they are being accommodative to the administration, no matter what they do, if they stop balance sheet reduction and they begin rate cuts. So they're going to have to communicate this, and the way they're probably going to communicate this is through the concept of ample reserves in the banking system, stopping balance sheet reduction because they're getting close to the point where there's going to be liquidity issues in the repo market. That will probably be how it's communicated, but that's going to be a questionable argument, in my opinion.
I was sort of mulling this over last night before we came in this morning. We became a bit obsessed about the basis trade in the last couple of months. Indeed, the Bank of England didn't become obsessed by it. They very much noted it. What is the risk of some kind of an eruption or reversal of that basis trade? It's been around forever. Yeah. We're just talking about it an awful lot more. So talk me through the risk from the basis trade, the risk from slightly faster positions.
Well, the risk is obviously that you're having the liquidity providers become someone who is very large and dependent, and we're dependent on that one or two liquidity providers. Just like in the past, in the financial crisis, when we were dependent upon dealers, primary dealers as liquidity providers, now we're dependent in the treasury market on basis traders, and to some extent primary dealers as well. So whenever you become overly reliant on one type of liquidity provider or another, you're always at risk. And the odds are eventually that liquidity provider is going to have a pullback, which will cascade into a full market liquidity hiccup. But by the way, that's what a market is supposed to do. Markets are supposed to seize up from time to time.
Tom, last question. We've been so U.S. focused, understandably so, but I do wonder the global bond story. It's not just a U.S. bond story, but we're seeing this play out globally. How do you kind of factor all of that in?
Well, I think the economic weakness is greater outside of the U.S., and so as a consequence, you should see other central banks beginning to pivot themselves and eventually move towards rate cuts. You should also begin to see other central banks pulling back from balance sheet reduction, as the Fed is eventually going to do. So there should be global support for the bond markets because you simply have a weakening global economy.
5 seconds. Do you have a favorite global bond market?
Right now, the U.S.
Ah.
All right.
All things hail the U.S. Splendid position. Tom, thank you very much for being with us this holiday. Tom Tesarius, strategist on all things markets. Well, if you're just joining the program and you're trying to understand where risk is at the moment, you have had 8 weeks of splendid run on the S&P 500, and that continues. Small, flat this morning. The consumer has not reached exhaustion point yet. We've just had Wedbush Securities saying you're going to have a 2-year bull run in tech. Euro-dollar trades flat at the moment, 110.12. When will the ECB cut? And will the Fed actually cut by 150 basis points? 10-year trades at 389. You could have a little bit of indigestion in the bond market going into 2024. And crude is flat at the moment, flat to bid, up by 0.25%, as there's some more heightened tension around Iraq and the U.S. military action against Iraq.
Yeah, it's kind of quiet, but it's interesting.
Yeah, I mean, I think the whole Iraq story and what's going on in the Red Sea at the moment is perhaps one of the biggest underpriced risks. And add into that is Taiwan for 2024 as well. Taiwan risk, China, Taiwan, U.S. risk has not gone away.
Well, you think about the conversation we were having earlier about how really the conversation is going to be dominated by politics next year. What a tricky situation for the Biden administration to try to navigate these different hot wars going on in the rest of the world while still trying to appeal to the American voter who is just really interested in domestic issues. You see that in the polling. So it's going to be a difficult road and really interesting to see how that plays out.
And the world is watching, talking to a very senior official at a global bank saying we're watching these elections, worried about who ultimately ends up at the White House after the November elections, because what does it mean for some of these global tensions that we're seeing and how the U.S. reacts and what the role is, watching very closely.
Exactly. And of course, we are waiting to see where we are with Congress on the shutdowns. Two different important dates this month.
I'm sorry.
Coming up.
Wait, wasn't that earlier this year? Didn't we deal with that already?
It never ends, just like earnings season. We are always on shutdown watch.
It's funny that you say earnings, because I love earnings. And I'm very curious to see what CEOs say about the environment, how much comfort they have in terms of putting out outlooks, what those outlooks are like.
Well, let's see what the recession word kind is like, or the disinflation.
We're never going to get a recession. We've been talking about it for 2 years.
It depends if you actually speak to people who run real businesses. It's been a silent recession so far. Coming up on the show, we're going to catch up with Caleb Muta, investment grade debt. Do you want some for 2024? Maybe, on Bloomberg.
There is a risk to shifting to a dovish stance. The risk is that maybe you gin things up too much and you don't make as much progress as you want on the inflation front. So no free lunch in that regard. We think the Fed's in a good spot. We do think rate cuts are coming.
Michael Gappin there, Bank of America Securities, head of U.S. economics. Good morning. It is Bloomberg Surveillance. Let's talk about the markets. You're coming back from hopefully a holiday, a day off. Do you want to be pro-risk in these 4 days before the new year, before 2024? There you go. Equities are up for eight weeks in a row, as we know. Big bullish.
Quite a run, right? Like it's just
monster.
But quiet. I mean, it's gotten so
quiet assassination.
Wait, does that mean like orderly? Like
no, it just means that the moves have become so small. We're moving to the upside, but we've really leveled out. It feels like, but it adds up on a weekly basis, as we've seen.
The question is of whether it's now a crowded trade. We know that in the bond markets, Citigroup are seeing really extreme positioning in the ultra long end of the curve, and that's where when things become very crowded, it doesn't take a great deal to dislocate it. Things like earnings. Look at Nike, down 12% on Friday, on the back of a $2 billion cost-cutting program, and talking about inventory.
Yeah, that is something. This is why I like earnings. Like, I want to see what companies are saying. Are they feeling wage pressures, as we talked about earlier, in terms of their cost side of the equation? What are they seeing in terms of demand? It is interesting, though, when a powerhouse like Nike is talking about some pretty significant cuts. Fundamental story, economic story, macro story. Like, you got to think about that.
And you saw a lot of its peers trade down in sympathy, of course, even though, it feels like some of these stories are idiosyncratic to Nike. There's just an underlying nervousness, and I feel like Friday's trade really showed that when you saw that big trade down.
And I think, when we look at some of these big retailer plays and some of the big calls at the start of, if you take your mind back a year, a lot has happened in a year, but at the start of 2023, it was a big call, pro-China, China's going to save us all, going to save the consumer, going to save the commodity market, going to save the industrials. Well, housing went into the trash can, tech got bullied, and the great China reopening trade simply did not evolve as we all thought. Look at really high-end luxury. It is suffering because they can't push out the product in China. Here we are. Goldman Sachs say they learned a painful lesson. China is no longer correlated with emerging markets, and that they are saying China's stocks fell by 15%, but the rest of emerging markets are in a much better shape.
Katie talked about this earlier.
I mean, the chart, it's really beautiful because it's just going in opposite directions. Of course, China to the bottom there, and emerging markets in general going higher. It feels like EMX China. It just rolls off the tongue, and I've said it so many times over the past few months because that's what people are saying. That's where they're positioned.
Well, go back to our last guest when we were talking about the bond market globally. What's your favorite market? The U.S. market, once again, really kind of outperforming, or at least feeling like it's a much more safe bet, if you will. And I wonder if that kind of plays into the corporate debt side of things and whether that's going to be investment potential in 2024.
Well, let's take that very thought. Carol wrote
You're welcome.
Carol wrote the question, just sort of threw it across to me. So let's bring in our guest this morning. It is Caleb. Joining us now on this subject is Caleb Matua, of course, joining us. Good to have you with us. So is it a case of investment-grade credit? It's a free ride. Well, there's no such thing as a free ride. But is it the ultimate trade? U.S. investment-grade credit will outperform perhaps the rest of the world. Good morning.
Good morning. Thanks for having me. So a lot of people that we talk to, investors, are very bullish about the U.S. Credit market. When we started this year, everybody said it's going to be the year of the bond. And then we saw a lot of volatility in March and whatnot. But now going into next year, we're seeing a lot of bulls expecting the Fed to cut rates. And these bonds really, because they're longer dated bonds, that's going to really be a huge push for these bonds.
So, I mean, how active do you expect the U.S. corporate market, and are there particular sectors that you think are going to be playing into it and tapping into it?
Yeah, we're expecting a very busy January. So if you, just for context, if you look back the last 10 years, the average for January issuance has been 128 billion. So next month, we're expecting 160 billion. So there's a lot of, expectations that a lot of these big companies are.
Why is it a little bit more in January this year?
Yeah, so next year. So first of all, financials are the biggest issuers in this market. They tend to come at the start of the year. They issue a lot of these bonds at the start of the year. And then you have earnings coming in. And a lot of these companies, once they report earnings, they're able to go out and sell debt.
Makes sense.
Exactly. Yeah, financials tend to be busy after earnings. But let's extend beyond January what the issuance picture looks like, because it feels like, especially this past year and maybe a little bit of 2022, issuers had to be very opportunistic. They had to look for their windows to sell bonds. With what's expected from the Fed next year finally reaching the end of its tightening cycle, could we go back to the environment where it feels like borrowers could come out any day of the week and sell their bonds?
Well, that's a really good question. So to your point, we saw issuers looking for windows to borrow. There's a lot of expectations that the Fed is going to cut rates as soon as March. And so that should be able to entice a lot of borrowers to come to the market. One thing that I would like to mention, though, is borrowers are still being very careful, because investors are, worried about so many things. So when you're coming to the market, you have to borrow for the right reasons, and investors are looking at this. We've seen a lot of issuance to refinance. We've not seen a lot of issuance for capex. We've not seen a lot of issuance to buy back stocks. And so yes, there's going to be a lot more windows to borrow, but corporations are being very, very careful about it.
Are we going to see more ESG bonds sold? Because we were having this conversation about EVs earlier, how it feels like automakers really over-egged how much EV demand there is going to be. And I cover exchange-traded funds. You take a look at ESG ETF flows, they're really not there. You've seen big outflows. You've seen those funds shut down. How does it look like on the ESG bond picture?
It's been a tough 2 years for the ESG debt side of things, because a couple of years ago, investors were happy to pay more and give issuers benefit to bring these bonds to the market, the so-called greenium. But that has changed. You have a lot of pushback coming from Republicans questioning the ESG strategies and what they call the woke capitalism. And so that's kind of making it harder for issuers to come to the market, because if you add a label to a bond, then a lot of people are starting to ask you, what is green about this? What is social about this? And so issuers don't want to just attract that kind of attention when they come to the market. And so, so that's really impacting sales, especially in the US. And a lot of banks that we talk to, they say they don't see that changing going forward. Not
it's
anytime
politicized.
soon. Very politicized.
Where are we on the narrative that you're going to face some kind of significant wall of refinancing in IG and in high yield? I mean, it didn't materialize. So what do the numbers look like for refinancing next year? And is that going to be an obstacle to the run?
Definitely refinancing is really going to boost issuance going into next year. We did not see a lot of that into this year, and partly it's just because you don't want to borrow with these very high coupons. And when we start to see rates go down, a lot of these issuers will want to roll over debt and take that opportunity to actually, refinance next year.
In a soft landing, what kind of default cycle are we looking at?
That's a good one. It depends on who you ask, really. In the investment grade side of things, we probably...
That's what makes a market a bid and an offer, and somewhere in the middle there is a reality. But I mean, this narrative is a soft landing. It's immaculate disinflation. It's 150 basis points of cuts. In that kind of scenario, if we look back at 1995, maybe that's what we need to do. Look back at 1995 for the last, in theory, soft landing for a default rate. But what is the bid and offer on it?
So a lot of people don't think we're going to see terrible defaults. Definitely we're going to see defaults, but not in a scary level. Definitely in IG, we're going to definitely see quite a bit of downgrades. A lot of people are worried a lot about regional banks, for instance. And so people just don't want to touch those kind of bonds, at least some of the people that I talk to.
Real estate debt?
Yes, I think that's part of the concern.
Commercial real estate.
Commercial real estate. And these regional banks have huge exposure to commercial real estate.
Okay, well, we'll keep an eye on that. Caleb, thank you very much. Caleb Muta, setting up the bond story on the investment grade and high yield for you going into 2024. Coming up at 8:45, we're going to talk to Dana Telsey at Tesley Advisory Group. She joins us to see whether the retailers have had a happy holiday. But how does it stand on risk as you're waking up this morning? If you've been celebrating your holidays, you need to rub your eyes. Don't worry, there's green on the screen for you. 8 weeks of a rally and more of a monster rally coming in tech, according to Wedbush Securities. We're going to have a 2-year tech rally. Euro-dollar is flat. Who will cut furthest and fastest between the ECB and the Federal Reserve? That will define the trajectory for euro-dollar and also the trajectory for 10-year government bond yields. 389 is where we are. Crude is inching higher as the U.S. Launches targeted strikes in Iraq this morning. For our audience worldwide, a very good morning. This is Bloomberg Surveillance, live on Bloomberg TV and Radio, alongside Carol Massar and Katie Greifeld. A very good morning. I'm Manus Cranny. Quick snapshot of what's going on in these equity markets this morning. The S&P 500, 4808.75. That is barely unchanged at 0.7%. You've had 8 weeks of a winning streak. We've had Wedbush Securities with us this morning saying get ready for more monster tech. Google, Microsoft, and NVIDIA. You're not going to see a year like you had in 1995 in the tech world, but 2024 could stack up as that. NASDAQ futures up 0.1%. The Russell 2000, Carol, you're making this point. This was the pickup last week that we hadn't seen for quite a while. So stocks at the moment muted. We had some good core PCE data that helped the bond market trade higher in prices, lower in yield on Friday. And indeed, we start the agenda here this morning. Two-year yields rising ever so slightly. We've just had Strategas with us talking about the bond markets and that really next year you're going to see this economy run hard. The kind of risk you have is maybe indigestion. 389.48 is where you are on US Treasuries. It's a full round trip from where you were at the start of this year. Could the yields back up a little bit because this market is perhaps a little bit over-concentrated, very much at the long end, extreme positioning according to Citigroup. Euro-dollar trades at 110.14, virtually flat at the moment. Let's get you up to speed with what's under surveillance this morning. We all got up early, but there is one story that is particularly important. It is about the tensions rising in the Middle East after a series of strikes in Iraq between the US military and what it called a terrorist group backed by Iran. The White House is claiming a drone attack struck US forces on Monday. That wounded 3 service members, including one critically. The US responding with airstrikes on 3 targeted facilities in the area. Now, in a statement, the US Central Command said, quote, early assessments indicate that these US airstrikes destroyed targeted facilities and likely killed a number of Kataib Hezbollah militants, adding that there were no indications of civilian lives were affected. When it comes to investing, ARK Invest CEO Cathie Wood making her first purchase of shares in the Japanese internet company LY in over a year. Now, the move indicates a possible shift towards a more positive sentiment on the operator of Yahoo in Japan, a popular messaging app line. Wood's ARK FinTech Innovation ETF buying a total of 1.7 million shares in LY. That was over Thursday, Friday, according to the trading update compiled by Bloomberg. The fund, well, that's poised for its best year versus the NASDAQ 100 since 2020. And be sure to tune in. Cathie Wood will join the team around the surveillance desk on Thursday at 7:30 a.m. Eastern Time, right here on Bloomberg Surveillance. Now, this one. Be careful what you do with your children at Christmas. Spirit Airlines issuing an apology after putting an unaccompanied minor on the wrong flight just before the holiday weekend. He was a 6-year-old, was set to fly on Thursday from Philly to Fort Myers in Florida to visit his grandmother, but instead he was placed on a flight to Orlando. The airline acknowledging the boy was, quote, incorrectly boarded, but did not address how the error came about. Now, no reaction in shares of Spirit, but the stock is down more than 13% year.
Incorrectly boarded.
Date.
What is?
It's brilliant.
We kind of screwed up, basically.
Also, I love the language unaccompanied minor. We're talking about a 6-year-old.
Young.
Holy moly.
He must have been mostly excited. I mean, it's like a Home Alone. It's a Home Alone adventure all on your own. By the way, I found my stat of the day, dreadful with the stat of the day, 7.5 million people are expected to fly, I should say, between December the 23rd and January the 1st. The busiest year in decades.
Good luck to them.
Very grateful that we're not doing that.
Yeah.
I just took Amtrak, but we can talk about that in a moment. That was a special experience.
We're working on it. We're working on Amtrak to make it better.
You know.
Okay, let's talk about Apollo Management, because the co-president there, Jim Zeltner, he calls private credit a $40 trillion opportunity and says a 2008-like crisis is unlikely to happen again after policy movers, well, they moved risky loans into private markets. He spoke to Bloomberg Surveillance at Apollo headquarters. That was earlier this month.
What is debanking and what does it mean for you and the team?
Well, you know, I don't use that term. I really use the evolution of finance. The reality is that the last 40 years, we had amazing tailwinds with globalization and technology and lower rates. Banks they were advisors for decades. In the 90s and the 2000s, they became large global institutions. 08, 09 happens, and there's a tremendous amount of legislation, Dodd-Frank, to change their business model, but at the same time, rates were lower. And in the last 15 years, the CEOs you're going to have on today from Wells and from other places, they're focused on ROE and their shareholder return. And as they're focused on ROE and shareholder return, there's a massive gap where companies need to find capital. And firms like Apollo, we've been at the front of the parade in terms of providing capital across our business. And when you put that together with our funding model of LP capital from around the globe, plus our retirement services, we're just a very unique player in that's going on.
We've got to get into how big the addressable market is and what are private markets.
Sure.
Typically, we think of leveraged finance. Mark Rowan, your colleague, who we'll catch up with a little bit later this morning, talks about basically everything that's on a bank balance sheet. How big is this going to be?
You know, when most people talk about, and you did a great job right there talking about private capital and private markets, most people, when they talk about private credit today, they talk about direct origination, which is about $1.5 trillion. It's about a third of the high yield and loan markets. We think the definition of private capital and private credit is around a 40 trillion number. And that would consist of, solar finance, inventory finance, trade finance, franchise finance, along with a lot of this corporate lending and investment grade privates that a lot of banks used to hold large chunks on their balance sheet. But again, in their search for ROE and appropriate returns, they're not the right place to hold that. They may be the right place to originate it, but they're certainly not the right place to hold it long term.
In our 3 hours with you, I think I want to get out of the way right away the stereotype that it's highfalutin, fancy derivatives, fancy structures, mezzanine. Everybody walks around and says mezzanine. We have mezzanine coffee. We have mezzanine Danish. But the reality is it's shockingly conservative. On your website, you lead with retirement services. How conservative, how measured, how prudent is Apollo?
Well, in the end of the day, we do not like to lose money, and that even means a penny. The reality is, if you look at our firm today, $630 billion, about $100 billion in private equity, about $100 billion in real estate and infrastructure, $400+ billion in credit. A vast majority of that is investment grade. And in this year alone, whether it's Air France, Vonovia, AT&T, we're loaning money to great companies that are, a lot of them are investment grade. And it's interesting, you talk around the globe right now, the last 6-7 weeks, buying investment grade debt of companies like Merck and Meta and many others, you've been making a double-digit return between the compression of spreads and otherwise. Now, that's in the public markets, but back to the private credit, to your point, we lend to large companies, mostly investment grade, and for our perspective, back to Jonathan's question, it's not a $1.5 trillion opportunity, it's really a 40 trillion opportunity.
So let's talk about where we are. You said you don't like to lose a penny, and yet you've been focused on investment grade, which has underperformed high yield. Risk has done a lot better than lower risk securities. Where are we in terms of where you can make the most money? Is it still an investment grade, despite where we are right now?
Well, it's in higher quality credit. The reality is there's still this debate, and you'll have it with Torsten later on, soft landing, hard landing, your friend Mr. Slock. But the reality is the economy we're sort of a little bit in this interesting Goldilocks period right now. Concern about a slowdown has been on everybody's mind the last 6-7 months. Fed's actually done a really nice job of maintaining higher rates. So I would argue that the Fed put its order back in the market right now. And the reality is you can make, as people are worrying about soft and hard landing, in credit, you've been making double-digit returns in the last 6 to 9 months.
So the Fed put us back. We can't let that go. What exactly does that mean? Does that mean that we're not going to have the same kind of credit cycle, that now you are a believer in soft landing?
I think what you're going to see is you're going to see an economy that there's going to be winners and losers, certainly like in inflation. You're seeing it right now in the goods area, where goods prices are lower but services are a bit higher. And I'm just saying, as the economy is navigating what's going on right now, the Fed has maintained fairly high rates. The market's gotten ahead of it, if you will. And if there were any kind of challenging economic backdrop, the Fed does have a loaded gun that they can use as needed and as appropriate. I'm not assuming it's going to happen. I think you're going to see what we're all expecting. We're students of history. We expect to happen in 08 to happen again.
Right.
I don't think you're going to see that happen right now. I think the actual reality is the banking system in the U.S., the envy of the world, and actually quite robust. There are signs of the economy that are a bit more challenging. There are a lot of buyouts that have been done that will have a challenging time, but you're just going to have to navigate it with a really broad toolbox.
You mentioned the history. On an almost cultural basis, one of my themes is we had 73, 74, Pittsburgh rolled up. You and I lived it in Western New York. And the bottom line is then we had 77, a second leg of a great bull market starting into the 82 expansion. Is that the analog right now, that after the gloom of the pandemic and the churning, that there's something new here, constructive?
Well, there's no doubt in the, if you talk about those four tailwinds that I talked about, globalization, lower rates, deregulation, the fourth is technology. And there are those who know a lot more about it than I do, but they would argue that we are on the precipice with what's going on with AI, cost structure, education, and the breadth of that could have a huge impact. But the reality is the cost of capital is going to be higher for the next 5 or 7 years. We are in a higher cost of capital environment, and it's how you navigate. And back to your original question, like the reality is the banking system around the globe is evolving. The U.S. is in the front of that. And as you'll hear about this morning, we think we are the player as that industry continues to evolve.
We've got to set it up for the rest of this morning. There will be people at home asking this following question, so help us answer it. Are we not just transferring the risk from banks and the risk they pose to the economy to places like this?
Well, we're actually taking the risk that was consolidated on a bunch of financial institutions and bringing it to a much, much broader system where we're diversifying that risk. Because our investors, at the end of the day, are either sovereign or other pension funds that don't own these assets on leverage, or they're other retirement services. So we're going higher quality assets, and we're diversifying the risk of the system. It's actually making the system less risky.
That was Apollo Asset Management co-president Jim Zelter there in conversation with the original surveillance team. Of course, you've got interlopers in here this morning. Katie,
happy to be an interloper.
Yeah. Of course, the reality. I think the most sobering thing that Jim actually said was get used to a higher cost of capital. We are obsessed by these 150, 160 basis points of cuts. That only takes you back to around, let's say, maybe 375. But the reality is this economy is going to function on a cost of capital to you and to me at around 4-5% on your mortgages. Let's take a quick snapshot of risk this morning. It is the 26th of December. If you're waking up a little bit more bleary-eyed, don't worry. Your equity market continues to paint green on the screen. Will that endure? Liquidity is going to be thin. It's going to be a quiet kind of week, although the news flow can stir at any time. Flat and phlegmatic on the euro dollar. Will the ECB go for a rate cut at the same time as the Fed? 60% probability of a March cut from the ECB. Yields trade at 390 at the moment. You've got a real extreme positioning in the bond market, according to Citigroup. And you may get a little bit of indigestion, according to Strategas. They were with us a little bit early, 390. Crude up by 0.6%, which is perhaps one of the more moving markets this morning, Carol, Katie. There's a couple of different things there, aren't there? There are the targeted strikes by the United States on Iraq. And then, of course, there is whether it's priced fully or not, it is the maneuvers in the Red Sea and the movement of ships away from the Red Sea and what's going to happen in terms of those attacks by Houthi rebels.
And maybe that's sparking some movement finally when it comes to the oil markets. Of course, oil has strung together a few weekly gains at this point. But overall, I mean, oil has been such a head scratcher this year, particularly over the last couple of months. A lot of that comes
expect it to be spiking, you would think, right? With some of the concerns.
I know, but then it comes back to the supply picture and that overhang there.
Yeah, I mean, you've got the U.S. pumping at will. You have non-OPEC supply virulent. And, of course, then Angola leaves the OPEC family. Now, you may say, well, what's that going to do?
Fascinating.
I also feel like the political support is more for like, okay, go back to fossil fuels, like we're backing off of alternative energy. It's happening too, but I just feel like the conversation's changed.
Well, the wording of COP was some would say, exceptional. We're not here to talk about that at the moment. We will come back to that. Coming up, what have we got for you? Madison Miller on this year's increase in popularity of the weight loss drugs. Have you bought yourself some Ozempic?
We are waiting to see the results. It's all about data. Data will speak. If the data are good, we are going to move into phase 3. We thought that the market will be 90 billion altogether, of which 1/3, 30, will be the orals. Right now, the market looks like it will be even bigger. So yes, it is a sizable opportunity if you have an oral anti-obesity drug.
That was the Pfizer CEO, Albert Bourla, speaking to us in October on the potential for weight loss drugs. And wow, did that move the markets. Let's just take a quick snapshot of what's going on with these markets. This is what we've got. I mean, we've been saying it for a while. The question is how much liquidity is in there, Carol, isn't it, for this 8-week run, and how much more endures?
It's my word for 2024, but it's also this, as we wrap up 2024, it's going to be quiet. We talked about people flying, right? A ton of people flying today to get back to home or wherever the heck they want to be.
That's true, yeah. Not a lot of people here to participate in this equity market. It is December 26th, but we're here, and it will be interesting to see how we are here. We're watching these markets. It's going to be interesting to see how we finish this year up. We know that, since late October, it's really been off to the races. But it really feels like maybe we've reached kind of a settling point. Maybe we've reached an equilibrium here.
Don't forget, there's $6 trillion sitting in money market funds. And if those rate cuts come through, that wall of maturity will roll off at the end of maybe, March. The big peak-on moment was March. That's when the flow of money went into the money market funds. You had First Republic, you had those other bank issues. So maybe there's some kind of a precipice in March in terms of liquidity from MM into equity or bonds.
Or does it go back to banks? Where is that money coming from? I think when you think about the flow of travel out of money market funds, where that cash actually came from really matters here.
I think it's really important. I'm also looking technically, like at the S&P 500. You look at something like RSI, Relative Strength Index. We are definitely overbought. What does that mean? Do we get a little bit of a pullback, but then do we resume the move upward?
Remember we had a one-day hiccup last week? Well, both of you guys weren't here, but there was one really ugly day. It was triggered really in the last hour or two of trading. I think it was on Wednesday. Time is a flat circle, so it's hard to remember. But those technicals start to come into play when you think about some of those indicators.
Well, speaking of technicals, I think about all of those companies and all of those names that are involved in the new class of weight loss drugs. So let's turn to two stocks posting double-digit gains this year, even as the broader sector has its first back-to-back loss in 2 years. Novo Nordisk and Eli Lilly rose as the superstar health stocks thanks to the popularity of their weight loss treatments. It was really between artificial intelligence and these weight loss drugs. I feel like you want to talk about two major themes this year. Of course, the Fed, that's a given. But these were two very important sectors in terms of market activity. So let's talk specifically, though, about the weight loss drugs. For more, she has been all over it this year. Bloomberg's Madison Moeller, and she joins us on this Tuesday. Madison, I've always enjoyed our conversations. I feel like we learned so much when we talked to you. We heard the head of Pfizer, the CEO of Pfizer, talking about the market size. Let's start big, broad, wide. How big potentially are the folks that you talk to saying this class of weight loss drugs could ultimately be, especially when they start talking about it's not just weight loss, but it's maybe other things that these drugs can maybe take care of, some really important health problems?
Yeah, and when we're talking just about weight loss, the number that we keep hearing is $100 billion by 2030, which honestly, that's not that far off. And that's a lot of money. And that's just when it comes to obesity treatments. That's not even baking in these other potential uses, alcohol use disorder or kidney disease or liver disease, that we're seeing more and more studies come out to say, wow, these drugs actually might have other uses beyond just weight loss. Heart disease is another big one. So this market could really only grow. And that still remains to be seen, how big it could actually get.
Madison, it feels like there's tons of cheerleaders on the side when it comes to these drugs and these names whenever any kind of news pops. Having said that, what are the concerns as you continue to cover it? And after a year where we were so focused on it, what are the concerns, though, when it comes to this class of drugs?
Yeah, so there's obviously the concerns with side effects and, continuation of usage. What we're starting to see is a lot of people stop taking the drugs sort of once they reach this weight loss, amount that they want to loss of weight. And we're also seeing insurance issues. Sometimes people, can't continue to get coverage, so they discontinue using the drugs. They also discontinue using the drugs because of side effects. So that's sort of one of the big concerns is long-term usage and sort of how that's going to play out. But we're also starting to see a little bit of a cool off or a little bit of a there's not as much excitement about Novo Nordisk going into this next year when we're looking forward to 2024. And we're sort of seeing the excitement shift to Eli Lilly because Eli Lilly has a really exciting pipeline of next generation drugs that are coming along. There's a drug in their pipeline called retatrutide that in studies has shown up to 30% weight loss, which is, rivaling bariatric surgery at that point. Novo Nordisk, in terms of next generation treatments, doesn't have as much in the near term, in the next couple of years. There's not as many big data readouts next year as we've seen every single data readout has sort of shaken up the market this year. And so we're sort of seeing a little bit less excitement around Novo going into 2024, and that's shifting to Eli Lilly.
So where are we, Madison, good morning. Where are we with healthcare coverage on these drugs? Because that's something that I presume changes the game materially again in terms of the size of the market.
Right, exactly. That's a really important piece of this. And right now, coverage is still spotty. I mean, Medicare does not cover these drugs. We are seeing at the state level, more and more Medicaid programs are beginning to cover the drugs. And even in 2024, we already have some more states. I'm in Chicago right now, and Illinois recently decided to start covering weight loss drugs in 2024. So we're going to see more and more coverage going into 2024 in terms of Medicaid. Medicare is still a piece of this that it doesn't look like that's going to budge anytime soon. And then when we talk about commercial plans, it's really sort of dependent on the plan, and the coverage is sort of spotty. But that's an extremely important part of this. The companies are lobbying substantially to get insurance to cover these drugs as well.
With that insurance narrative, with Medicare and Medicaid, as you said, Medicaid, not Medicare at the moment, what does that do potentially to the margin on these products? And I ask you that question because I look at the price of where Ozempic was in a country that I came from, to the United States of America. I can tell you it's almost 50% cheaper to buy the Ozempic in the United Arab Emirates than it is to buy it here in the US. So where are we with margins as a result?
Yeah, it is. It's helping. The rebates are definitely helping slash the price. And for people who do have insurance coverage for these drugs, they're not going to be paying $1,000 a month. And you're right that one of the things that continues to come up is the fact that in other countries, these drugs are substantially cheaper, which this is always the narrative with healthcare in America when it comes to pharmaceutical products and drugs, is that they're always just more expensive here. And so that's something that is going to continue being a conversation, I think. And one piece of that as well is more companies enter this market and as more products become available, there's the assumption that the price of weight loss drugs sort of across the board is going to come down. So that's something that experts are hopeful for, and they're hoping that more competition is going to enter the market, hopefully soon, in order to bring down the price of these drugs, because right now they're just extremely expensive.
And Madison, something that has plagued these drug makers, and Novo Nordisk in particular, of course, is supply shortages. Basically, with all this demand, they haven't been able to make these drugs fast enough. Where do we stand on that story?
Yeah, and you're exactly right. And we're seeing Novo Nordisk is continuing to limit first doses or new prescriptions continuing into 2024 because their supply issues have just really plagued the company this year. Eli Lilly looks to have a better handle on it at the moment. We're looking at the FDA supply shortage database. All of the dosages of Eli Lilly's drugs that found are in supply right now. But they've said, and their CFO has told me that they, continue to see tight supply going into 2024. So they're going to be monitoring that. Both companies are investing heavily in ramping up production. I feel like every week there's an announcement of a new plant or something.
Madison, I got to do a quick, hard turn, but COVID, do we even talk about it? 20 seconds? I just had another round of COVID last week. I was out.
Oh, did you?
Yes.
Oh, no.
So is that still a story we need to think about 2024 very quickly, if you can, in 10, 15?
So we're seeing cases rise across the U.S., and I keep hearing about people getting it as well. There's a new variant out there. I think it's sort of similar to the ones we've seen, but, COVID's still around, and so it's important.
Yeah, I'm just going to tell you, it is important. Put you out.
Yeah.
So appreciate it. Madison joining us. Madison Muller, of course, Bloomberg News, covers healthcare, covers everything with the weight loss drugs, everything in healthcare. So we'll be following her well into 2024. Quiet morning. Futures, S&P just up about 0.1%. We're looking at the 10-year at 389. Don't go anywhere. We're talking markets. Coming up next, Matt Miskin of John Hancock. What he has to say, balanced portfolio, bonds, stocks, Where do we go? It's coming up next.
The signs are that the inflation dynamics have really exited that pandemic.
We can enjoy modest growth and disinflation, and it does suggest that the last mile may not be overly difficult.
You mentioned the phrase immaculate disinflation, and I think that's what we've had.
In terms of jobs cracking and inflation all of a sudden collapsing, it's not there in the data.
If I had to describe 2023, better than feared.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
And a very good morning, everyone, from New York City for our audiences worldwide. This is Bloomberg Surveillance, live on Bloomberg Television and Radio, alongside Manus Cranny and Katie Greifeld. I'm Carol Massar. We're in for John, Tom, and Lisa on a day and in a week where it's really expected to be very quiet because of the holidays, but we are getting ready to wrap up 2024. It's been quite a year. Let's just quickly bring up what we're seeing in terms of the market action or lack thereof, I might say. Take a look at futures, because we've been on quite a run when it comes to the S&P 500. But right now, we're just up about 5.5 points. 48.10 is the read on S&P futures, up 0.1%. Taking a look at the 10-year, we've got that at 390, so just a little bit of movement there. We are keeping a watch on New York crude. We've been talking about it throughout the morning. Concerns about the Mideast tensions, the war broadening out. So we're watching New York crude. It's just up about 1%. So it's building some strength to the upside, momentum to the upside as we work our way through the morning. Having said that, it's kind of interesting. Guys, I feel like reading in, there was a lot about the Santa Claus rally that we have seen this year. And I was looking at some notes. Craig Johnson of Piper Sandler, who's their chief market technician, he said, since 1928, the market has rallied an average of 1.7% between the last 5 days of December and first 2 days of the new year, with a 79% positivity rate. Okay, so a little bit of
I like the 79% positivity rate. Is like, yeah, we're cranking on gas here. Let's get the last 4 days
hard
of the
to
year.
fight that one. I mean, seasonals are real. It's really easy to make fun of the Santa Claus rally, and I often do. But you just think about this period of every year, and it seems to be pretty good, except for, of course, last year. But we don't talk about that.
I think some of the positioning going into this final week, and even this setting the stage for 2024, is quite extreme. We know from Citigroup's analysis, the positioning in the long bond is extremely long. Asset managers are the most long since 2019. So how much of that move down in yield on 30s, down in yield on 10s, is already very much priced in? We've just had a conversation with Strategas this morning, who said get ready for a little bit of indigestion, and Strategas doubt the market, that you're going to get 150, 160 basis points of cuts. 50, 75 offered.
Yeah.
Tops.
Well, that's the thing. It feels like after we saw Powell's performance at the December meeting that there had been a fight against the Fed, and maybe the markets actually won because Powell actually was way more dovish than anyone was expecting. But now heading into 2024, again, this big gap between what's in the dot plot and what the market has. I don't know who wins that round.
And don't send us hate mail, or don't send me hate mail, but I'm just thinking about what people were saying at the beginning of last year in terms of what kind of market we were going to have. And a lot of people got it wrong. Not everybody got it wrong.
Name some names, you know.
I love you all. No, but I just think
she wants to come back tomorrow.
It's just a reminder. I do. I'm sweating a little bit. But no, it's just a reminder that, a lot of things got thrown at us that I don't think, obviously, nobody anticipated. And it's just a reminder that we are living where things are happening overseas, really serious stuff that can change tone, sentiment, and really market reality and fundamentals in a snap.
Look, I think we're all waiting to see whether the disinflation story really accelerates.
Yeah.
I'm not saying there's a risk of deflation, but it's how much more of a material progression of the disinflation story continues. The core PCE on a 6-month annualized basis came in sub 2%, and that is important from the data. What are we, Carol Massar? We are?
What?
Data dependent.
Oh,
yes, we
2
are.
hours ago. That just shows you we've got the memories of goldfish.
This was a long time ago.
This is why our producer is buying us some coffee, because I need a little bit of a help. All right, let's see what Matt Miskin has to say about all of this. Co-Chief Investment Strategist John Hancock, Investment Management, joining us just outside of Boston. Matt, great to have you here on this Tuesday. There's a lot that could come at us at 2024, but as you look back at 2023, are there, trends, narratives that you think will, no doubt about it, carry over into 2024?
Yeah, thanks, Carol. And really, the last 2 months defined 2023 markets. And it was all really around Powell's pivot. So in September, they were forecasting another rate hike in December. And then actually no rate cuts into 2024. That really changed significantly. So now, of course, in November, he went to no hike in December. And then in December, really pivoted. I think about the pivot foot. I mean, it almost looked like a travel here where that pivot foot moved because they did a 180. Powell did a 180 from his tone in September to November. And I look at small cap stocks in particular as the biggest beneficiary, down 5% on a year-to-date basis before November 1st, and then ending. Right now, they're up 17% year-to-date. Again, in the futures market, even though this is a quiet week, small caps looking up the highest in this morning trading.
Talk about a 180, right?
Exactly.
Do you think that that's where we go next? And I mean, if you look at some of the you look at some of the performance on the U.S. equity markets, just top lines, S&P 500, 23% on the year. There it is over the past 2 months. So more than 50% of the move was done in the last 2 months. You said the optimism is already very much baked into stocks, both in earnings and estimates and valuations. The math for you is not compelling. So if it's not compelling, there's the Russell, by the way, up over the past 2 months, up 22%. The math not being compelling, what does that do? Do I stall? Do I draw down? What happens? Do we shudder in January because the bond market is convinced we're on a slice and dice from the Fed?
Right. Yeah, I mean, Russell 2000 earnings are down 17% this year. Price is up 17%. I mean, one of the ones I love the most is technology. And Karen was talking about earnings and loving earnings. I love earnings too. Technology earnings are up about 5% this year. That's not bad. S&P 500 tech, 5%. Actually, that beats most of the world in earnings. The companies are up price-wise 55%. So that just shows you how much this has been multiple expansion versus earnings. It's all about Powell this year. And it really all came down to the last 2 months in this pivot. I don't think that next year is going to be that meaningful as it relates to everything relied to the Fed. I think fundamentals going to matter more. Economic data is going to matter more. And I think the Fed is in a tough position because the soft data has led you blind this year. It's all been, you've had to really focus on the hard data. The thing is, the hard data lags the soft data. And so they just have to wait. They have to be data dependent, Manus, just like you said. So right now, they're going to wait on that. And I think they're going to have to wait right to the last minute to cut. And I think that may be too late. And they're going to have to cut more aggressively than actually the market thinks.
Well, Matt, I don't really like earnings. I really like talking about the macro. And it's been convenient for me because, to your point, you've seen equities really be driven by the macro, even at the single stock level. But I want to talk about the different psychology between the equity market and the bond market, because I love this line in your note that stocks are stories, bonds are math. Talk us through that a little bit, what you mean there.
Yeah, so with the bond market, it's going to be your income. And income right now, even though it's changed a lot in the last 2 months, I mean, we were writing that, a month ago, and we were like 5-6% in high quality bonds. This is amazing. We've been looking for high quality income at these levels for years, and finally we're getting it. It's still about 4 to 5%. We think actually 4 to 5% is an income stream where you can depend on that, and high quality bonds will be an attractive return stream into next year. And we've been talking about cash, right? $6 trillion of money markets on the sidelines. Well, what is that yield going to be like next year? If it's 5 now, that could be down to 4 or 3%, depending on how much the Fed cuts. And then subsequent year, it could be even lower. We don't want to have variable interest streams. We want to fixed income interest streams. And that's about the math. We like that, the factual parts of that. Right now, stocks look like your high multiple, high earnings estimates. And sentiment is all about soft landing. That can change quickly into 2024.
Matt, I just want to follow up quickly on that money market point that you raised, because Manus and I have been batting this around all morning. Where does that money belong to, that cash that's come into money market funds? When it comes out, does that belong to risk assets, or is this maybe stickier than usual when you think about the banking story?
Yeah, Katie, what we looked at when we've seen money market assets like this before, we trend it over time. And what we've seen is money market assets usually rise going into a recession. They actually accelerate, and everybody sells right at the low of the market. And that's actually the peak in money market assets is the trough in the S&P 500. Happened in 2008, happened in March of 2020, and now we're building. And then, so where it happens on the flip side of that, I think it actually finds a home in a balanced portfolio. Stocks and bonds usually get the biggest beneficiary. Bonds do have some inflows this year, about $100 billion taxable fixed income. That's the highest outside of money markets. but it's still a fraction, 10% of what money markets took in, taxable fixed income put in. And that's what I struggle with the bond sentiment. We're not seeing that overly aggressive bond sentiment or bullish bond sentiment. We actually hear investors that are still pretty cautious, and they're saying, we're going to wait till next year to buy bonds. And the thing is, bond yields have moved really fast, a lot faster than usual. And we don't want to have those yields go away before you actually get an opportunity to take advantage
Well,
of it.
and that's what I was thinking, for such a big period, I feel like we're saying, listen, look what the bond market can give you at this point. So why not lock it in? Less volatility, less, concerns over riskier assets such as stocks or elsewhere. But having said that, you're looking at your 401k for those who are lucky enough to have one and saying, wow.
I just signed up for one.
Well, good for you. But you look at those equity returns, and mind you, a lot of it was, towards the second half of the year and just in the last month or two. Having said that, how do you justify the bond story when you can many times over, if you just easily throw it into an index fund again?
Yeah, and I mean, I have conversations with friends and family, and they're all saying, why do I own these bonds? I'm going to go all in on AI or, whatever the thing that's up the most. I'm going to get more of that. And it's just, it goes back to behavioral finance principles that we learn about where, you always want to have the thing that's performing the best. You want to sell the thing that's down the most in your 401k or portfolios. And it's to us about rebalancing in times like this where you have such a huge run up in stocks versus bonds or whatever other asset classes, more disciplined approach. So we're looking to rebalance, trim some risk into next year. We think, again, a lot of the run up has been built in to the equity sides of portfolios, rebalance that into higher quality parts of portfolios like high quality fixed income and get that income stream into next year.
Yeah.
So that's how we would look at it.
Yeah, some things never change, right, in terms of either a balanced portfolio and the importance of bond markets in your strategy. All right, listen, we got to leave it there. Matt, thank you so much. Happy New Year. Matt Miskin of John Hancock Investment Management. We appreciate your time on this Tuesday. Having said that, we're looking at a market that's, really still quiet. I'm going to go to crude, though, to begin with, 1.5% higher because we are seeing,
big move.
Right, momentum build over what we've been on air a couple of hours now, and we've definitely seen momentum in terms of concerns over the Middle East. S&P futures, folks, up 5 points, up 0.1%. All right, everybody. One of the other things that we're going to be watching, not only the broader market, but we are also going to be talking about retail, which has really had some significant outperformance in 2023. But not all retail is alike. And so coming up at 8:45 a.m., we're going to talk with Dana Telsey of Telsey Advisory Group on this year's holiday shopping. And it was really kind of interesting because coming into, I was here on New Year's Eve, retailers, they were closed like 4 o'clock, 5 o'clock. I feel like gone are the days pre-pandemic where everything was open Thanksgiving evening through Thanksgiving and till the bitter end on Christmas Eve. It feels like it's a different tone.
Well, it's also where people are shopping because it feels like they wouldn't necessarily be going to those stores at the last minute. They'd probably be online. I mean, that was really the story of, the Thanksgiving holiday shopping period this year, just the amount of dollars being spent online. I don't know about you guys. That is where I almost entirely do my shopping.
I helped the American economy in a whole variety of ways this year. A little bit of light shopping. Shoppers spent $1 trillion on credit cards. You're looking at an increase, $48 billion added in the third quarter. And that was on the extend and pretend.
And buy now, pay later. I mean, that is one of the big stories this year as well. People are just really diving in. What does that mean when they have to actually pay later?
That's the extend and pretend trade. That's the Irish version of that.
But some have said that they're doing that. They're knowing that they have a few days or a few weeks or a few months to pay before the interest rates start to tick in, that they're positive enough that they can pay it. We'll see what Dana Telsey has to say. Coming up, Norman Rule. He's joining us.
Look back over the course of the year, it is really stunning how much progress the economy has made. Inflation's come down faster than even the more optimistic forecasts, and growth has remained very resilient along with a strong employment. If you recall, a year ago, the consensus projection was that getting inflation down would require a spike in unemployment and a recession.
All right, everybody. Of course, that's the voice of Lael Brainerd. She's National Economic Council Director, speaking just on Friday. And obviously, everything that we're hearing in terms of how the administration sees the economy, and certainly from Fed speakers, we are expecting an aggressive rate-cutting Fed come 2024. That seems to be built in. But, you know, what happens is there's economic data, right, guys? There's also geopolitical. And that is something that, once again, we were reminded this morning on our read-in.
And of course, how that impacts the market, it matters chiefly for investors. You haven't really seen it in oil, but maybe just in the past week or so, the past couple of weeks, you're starting to see crude price in some of those geopolitical risks that we know are intensifying and multiplying.
Well, let's bring up the market boards. And specifically, let's take a look at what's going on with crude oil, because we are seeing momentum to the upside and building. Watching the trade in real time, too, you just see it continue to edge higher. We're now up 1.7%. Pretty significant move, guys. 74.79 a barrel. This is the U.S. military launched strikes on 3 installations in Iraq, targeting what is said to be a terrorist group backed by Iran. So certainly watching what's going on in the Middle East. Having said that, we've got a great guest. Norman Rule is former senior U.S. intelligence official and senior advisor of the Transnational Threats Project at the Center for Strategic and International Studies, joining us on this Tuesday. What do we need to be thinking about as we continue to watch these headlines and what seems to be escalation of the Middle East conflict, Norman?
Good morning. Over the last several days, we've seen a multi-front escalation of violence through the region. We have the Israelis moving from a holding pattern in North Gaza to Rafah and Khan Yunis, which is going to be the most difficult and challenging aspect of the war, but it's the location of the Hamas leadership, hostages, and a vast array of tunnels, perhaps twice as many as Israel anticipated. We've seen the attacks by Kataib, Hezbollah, and U.S. forces, and the U.S. response against 3 sites in Iraq. That is demonstrating a capacity for retaliation, but not necessarily deterrence. We've also seen the Israeli believed killing of the most senior Iranian Quds Force official since Qasem Soleimani. He was responsible, reportedly, for the shipment of Iranian weapons to proxies in Syria and Lebanon, and his death will require some sort of Iranian retaliation. And last, we've seen some modest continued action by the Houthis against shipping in the Red Sea. However, that's been offset by a growing number of ships from a variety of countries, and Maersk has resumed its shipping through the Red Sea, Arabian Sea area.
They have indeed, Norman. They've resumed that, and that is the coalition of up to 20 countries that are now affording protection. So I think that is quite progressive. I want to draw on your experience. You were the principal intelligence officer overseeing national intelligence policy on Iran and Iran-related issues. I sat down with the Iranian foreign minister when he was here at the UN. I specifically asked him about were you scaling up in terms of troops, in terms of ships, etc. Of course, he prevaricated and accused me of perhaps interrogating him rather than interviewing him. The essence of it is this. When you look at where Iran are escalating via their proxies, where are the weakest links, as it were, for the coalition of the West? Is it in Lebanon? Is that the highest flashpoint that you can see? Or is it this one-off reprisal from the US into Iraq? Where is the weakest link for the coalition at the moment?
The most important area for focus, I continue to believe, would be the Red Sea. We have to watch for the possibility of the Houthis using explosive drone boats, perhaps mining, and perhaps believing that the retaliatory capacity of the coalition is weak because it is untested, and the U.S. is now pretty much advised it's not interested in escalation of regional conflicts. So I would look there as a result, as a response from the proxies. We do have the Lebanese challenge. An Israeli soldier has died today from wounds he incurred from an anti-tank rocket a few days ago. But the Lebanese Hezbollah appears to be constrained by its own perception that it doesn't want to be involved in a conflict that could bring strategic damage to its own equities.
And Norm, since October 7th, of course, the Hamas attack on Israel, the guiding thought here has been that the administration, really governments worldwide, don't want that to broaden into a wider conflict. But you think about what's happened over the past few weeks, of course, with the Red Sea, and now these drone attacks in Iraq. Is that starting to look inevitable?
Well, what's happening is that the world posture of opposing any expansion of the conflict is inevitably eroding the deterrent capacity of the international community and collective security. Iran's proxies are testing red lines. They're seeing that some red lines are pink, and they're also normalizing a certain scale of violence. There was a time when medium-range ballistic missile shots from Yemen to Israel would have seen as something to spark a regional conflict. And now it really doesn't make the news after a few hours. So the normalization of violence is a very troubling issue.
Hey, Norm, there's another story on the Bloomberg coming out late last night that Israeli Prime Minister Benjamin Netanyahu outlined three prerequisites, to achieving peace in the war with Hamas: the destruction of the group, the demilitarization of Gaza, and for Palestinian society to be de-radicalized. Those seem pretty rough metrics to hit. Having said that, there is a lot of pressure on Israel to end this. What is the likely outcome? Is the pressure building that you think there could be some kind of truce created sooner rather than later?
The head of Hamas has made an announcement also during this period in which he has refused surrender and has made some outlandish claims on Israeli losses. When you look at Prime Minister Netanyahu's statement, the most troubling aspect is actually the de-radicalization of Gaza society. That is something that would take months, if not years. And the international community doesn't have a lot of experience with this, although Saudi Arabia and the Emirates do for their own world. I think it's also notable that Netanyahu did not mention the hostages, and he's come under significant pressure from Israeli hostage family for not doing more to bring back the roughly 100 plus hostages who remain in Hamas hands.
Will we hear a different rhetoric from the White House, from the Biden administration going into the new year?
I don't think so. The White House will likely continue to express support for Israel's right to defend itself and to punish and eradicate Hamas's leadership, but also you will see continued pressure by the United States to bring in more humanitarian supplies. Israel will respond correctly that the more fuel that comes in, if Hamas uses that fuel to retain control of tunnels, and that extends the conflict. But I think you're going to see a continuation of the administration's narrative.
Norm, is it, though, time for the administration to change that narrative? If you consider some of the pressure, the global pressure, and even pressure within inside the United States?
And that would be difficult. It would be difficult for Israel, which has gone through the October 7th massacre and the bad news on hostages and the losses of its own personnel, to say that it would tolerate the continued existence of Hamas's top three military leaders and the radicalization of a society on their border. I think what we should look for is the likelihood that Israel will increase its focus on eradicating the top three personnel in Hamas's military leadership, or perhaps forcing them to flee country.
All right, going to leave it there. We so appreciate your time this morning. A very important story for everybody on this Tuesday. Norm, thank you. Norm Rule of CSIS. We really appreciate him joining us here. You know, it's this. I feel like we're getting to this point where do we widen out and it becomes a much bigger situation, and it feels like we're just kind of possibly there, or is there some way of bringing it to an end so that we can move on?
Well, I think unfortunately, from a human point of view, the toll is just ever increasing, and that's why I think you're right to ask the question: do we see a shift? Will there be a shift from the White House? From a market perspective, a 1.5% lurch in the price of oil from 6 a.m. when we came into the studio to where we are now is significant, and that talks to the ongoing risk from Houthi rebels in the Red Sea. Even with a coalition, a protective coalition, Mullet Maersk are back bringing their ships through that avenue, but that can bring flashpoints in of itself, and that's the risk.
And that can change in a moment.
And I'm glad you brought up crude, because I don't know how your conversations have sounded really since the highs of October, but for me, it's been a lot of what wakes crude up. And maybe we've reached that point. It'll be interesting to see, of course, whether that continues into 2024.
Well, the spreads have tightened as well. So the presumption is that these deficits, in theory, the theoretical deficits, will appear in the first quarter of 2024. Just a little bit of a sidebar.
Absolutely. Keeping a watch on New York crude, just bringing it up. WTI crude futures up about 1.9%. We've hit above 2% in this early trade, but we're going to keep a watch right now, just below it at $75 a barrel. Dana Telsey, we're talking retail. That's next. All right, welcome back, everybody. This is Bloomberg Surveillance on this Tuesday. Carol Massar, along with Manus Cranny and, of course, Katie Greifeld. And we are watching, certainly, the markets. It's quiet, certainly, on the equity front. No surprise, as a lot of people are traveling today. We've had quite a run-up, a little bit of a breather, certainly, on Friday ahead of the holiday weekend. But what we're really focusing on is not the bond market, 10-year at 389, but New York crude. We've been above 2% in the trade here early on, still up about 1.9%. So up $1.40, 74.97 a barrel. This is on concerns that what is going on in the Middle East is broadening out, involving maybe increasingly the United States. And so let's go there, because that is one of our headlines this morning. Under surveillance this morning, the U.S. military striking 3 installations in Iraq, targeting what it called a terrorist group backed by Iran. Now, the Pentagon accusing the group of a series of attacks on American personnel. This comes as tensions rise in the region with the Israel-Hamas war and the shipping attacks in the Red Sea, a very crucial trade route. And if you can't go that way, first of all, you got to go a longer route. It's going to cost more, but it's just a reminder of how these geopolitical tensions impact the market. So big deal.
Yeah, and I'm glad you brought up the Red Sea and what it means for the global supply chain. It really feels like we're finally at a normalized point when it comes to the supply chain. You think about all the snarls that we had during the pandemic, maybe working themselves out. Now we have another headache in addition to the geopolitical implications.
Yeah, but do bear in mind, I mean, even though you're now looking at over 100 ships redirecting away from the Red Sea, you do have one of the biggest, second biggest container company in the world, A.P. Moller-Maersk. They are returning to the Red Sea to resume shipping through the Red Sea. And again, you've got this coalition of the willing in terms of a protectorate across shipping. And look, this is incredibly important from the supply chain point of view, but also from the messaging back to the proxies in terms of the defense that the coalition will bring to bear to try and keep things contained.
I guess I would say they're not going to do it if they think something's going to go wrong. Having said that, if something goes wrong again, then you start to see a freeze.
It's the scale of what goes wrong. It's incremental. So far, there has been no monumental debacle in those shipping lanes. It's whether something of scale and size really changes.
A different kind of debacle, as they say, and that has to do with Samsung. They're delaying chip production plans at its new Texas factory. Let's walk you through the story a little bit. This is according to the Seoul Economic Daily, the company pushing back mass production at the $17 billion lab to 2025. It had been scheduled to start in the second half of 2024, so pushing it out a little bit. TSMC also postponing production at its Arizona site in a string of blows to the Biden administration's ambition to boost domestic chip supplies. We know everything has chips, increasingly so, and we've seen really a global move, Katie, right, to up production and also bring it back home.
Yeah, you think about supply chains. Obviously, the Biden administration really wants to avoid a repeat of what happened in 2021 when you had that shortage, wanting to bring these chip makers to American soil. That's still the plan, but now a little bit delayed. We'll see if it gets delayed again.
Yeah, I mean, look, the CHIPS Act promised $100 billion in support for the semiconductor industry. I was on a call with Oliver Crook, who's our resident German reporter. It's interesting. He said every CEO that he speaks to in Europe is obsessed by the Inflation Reduction Act. And
really?
Yet here,
That's interesting.
And yet here, when you come to live here, and I'm a transplant, I've come to live here from the Middle East, from London, it's as if, you know, these policies are very politicized. I understand that, from the Inflation Reduction Act, the CHIPS Act, very political, rather than seeing them as some kind of metamorphosis of the infrastructure and the technology infrastructure of your great and good country.
We should start asking
which got a visa, but not residency.
Gotta start asking American CEOs, are you obsessed with the Inflation Reduction Act? I don't know.
On those earnings call.
Exactly.
Well, we talk about liquidity. That's another round of liquidity that has come into the market as a result of that measure. All right, one more story for you under surveillance. Shares of Manchester United getting a boost after Jim Ratcliffe agreed to buy a 25% stake in the football club. It's a $1.3 billion deal, which values the club at about $5.4 billion. Ratcliffe's purchase marks the end of a drawn-out sale process of Man U that began over a year ago. It's been a little bit tortured, to say the least, Manus.
It has. I mean, but this is a battle of the billionaires. As you said, what do billionaires do? They buy American, what did Ken Griffin?
They buy big boats and they buy sports
teams.
They
love rockets, too, but sports teams.
Rockets, sports teams. So do the Saudis. The Saudis love buying football players, sports teams, and here we are. This is finally closed. The Qataris lost out. It was thought that the Qataris would pay up to $6 billion. Jim Ratcliffe, we know, has paid up to $33 to take a
that's interesting, the Qataris, right? Because you see the Middle East wanting to get increasingly involved in big sports.
I would have thought that the Qataris would have just gone full pay. I'm actually genuinely surprised. But here's the thing. There is a zeitgeist and there is also very much a British feel to this. It's a British billionaire paying $33 a share, taking 25%. He's putting $300 into the club. Will he bring back somebody? Will he create a new David Beckham? That's the question. That's all the Carol wants.
Watch the
She's just finished watching Netflix.
That's my whole reference point. Watch, and I got to tell you, David Beckham. I can't even get it out. I told you I need more coffee. His closets are immaculate.
Yeah,
that's
beautiful.
what I got from the documentary.
Him and Victoria, what a power couple. Holy moly. I mean, I knew that. I was born and grew up in the 90s, but to see it again in film, it was a nice reminder.
It's the fact that you see him as a beekeeper in his country estate.
It's pretty cool.
Just says a great deal about the individual.
Very successful individual in terms of obviously how he played, but then what he did with it afterwards.
Yeah. That's what's called global branding. Believe in the brand, believe in the power, believe in the power of the market. Does Michael Purvis, the founder and CEO of Tolbacken Capital Advisors, believe in the power of immaculate disinflation, 160 basis points of cuts and full bull of flow into equities? How bullish is your cup, Mr. Purvis, this morning? Good day. How are you?
Very well. Thank you, Manus. In terms of my broader outlook into next year, I'm quite constructive on risk assets such as equities, particularly U.S. equities, and there's a lot of reasons for that. But you also referenced 6 cuts, and I think it's almost 7 now between January 25 and today. And I think there's a little bit of a disjunction going on. If 7 cuts is really coming, then I'm not going to be so bullish on equities, right? I certainly love the fact that we've reached the apex of this extraordinarily violent hiking cycle there. But if Powell's really going to cut 6 or 7 times over the next 12 months, it's probably because there's something beyond just inflation cooling off, and therefore I think that's really from my perspective, that's not Dove love coming back and the Fed puts back in business, so just get long equities. No, I think that's actually probably a real cautionary view. But I am constructive on the economy. I am constructive on the earnings profile, broadly speaking, next year. I don't think it's going to be quite that, oh my God, we don't have a recession upside condition that we had that's going to define so much of 2023. That sort of upside surprise factor is gone. But I think it's going to be held together pretty well by a decent nominal GDP picture. And I think the big tech earnings are going to continue to be, a real driver of overall earnings and an overall reason to, be, heavily engaged in this stock market.
And Michael, talk to us a little bit. You mentioned that if the Fed is cutting 6, 7 times, it's not necessarily the Fed put, et cetera. There was a really interesting note out from Citi last week, I believe it was, saying that pullbacks here are an opportunity to buy a little bit more, basically saying that buy the dip is coming back. Is that the proper mindset for 2024? How are you thinking about that?
Yeah, you cut out for a second. I think you were talking about buying the equity dip, not the bond dip, right?
Yes, equities.
Yeah. Look, I think when you step back and you think about what happened in 2022 and then 2023, you had a big surprise to the downside in 22. A lot of people caught off on sides there. And then you had a similar thing in reverse this year, really. And I think you have to understand so much of that rally this year was really instigated not by dramatically accelerating fundamentals so much as it was, wow, well, there's not a recession, and by the way, there was a massive positioning off sides. And I think that, you tend to think of positioning mismatches as things that play out in a couple of days, a couple of weeks, maybe a month or two. This was a whole year of it. And I think a lot of big allocators were really just sort of playing catch up here in the second half of the year because they were probably overweight bonds and underweight equities from last winter. As we get into 2024, I think we are that positioning mismatch is going to be largely behind us, and I think it's going to be much less of a factor there. There's always going to be positioning mismatches and people on too far on one side of the boat. But I think what's going to happen is going to be a little bit more of a healthier, more rhythmic equity market condition. there. Yeah.
Michael, is it safe to say that we are through all of the pandemics? I feel like every market conversation we've had over the last couple of years is like, okay, well, wait, we've got to think about where we were pre-pandemic, and we have to think of, factor in all the unprecedented stimulus that we saw globally, and we constantly are catering and couching everything in that mode. Are we through that? Are we back to kind of normal?
Well, it's funny. I don't think you could ever get completely back to one point in time, right? That's but I guess your question is, have we normalized so much of the COVID specific issues, whether it was supply chains or monetary stimulus or fiscal stimulus? I think, most of that has been sort of processed. I think what is so important, though, in this discussion is that during 2020 and 2021 and 2023, there was this emergence of longer-term structural trends that had nothing to do with COVID, but it had to do with energy transition, it had to do with deglobalization, had to do with, you were talking about commodities and oil prices earlier, and I do think that there's a different condition emerging with higher geopolitical risks, and also just, commodity producers being more less given to supply expansion. You were talking about oil, but look at iron ore is up 50% in 3 months. Look at copper prices; those look ready to go higher too, even without China. So I think there's a lot of new, more structural, slower moving conditions. And one of the things that I think investors have to keep in mind is that we've been almost inured to like 3 years of some of the very violent price action and economic activity and shocks. And I think what's happening is there's slower moving but very, very significant sort of structural themes that are starting to really play out there, and that are very significant. So that's the way I sort of try to contextualize that sort of, yes, we're not going to normalize to 2019, nor should we. We're normalizing to something else, but the big shock and awe are behind us.
Okay, Michael, shock and awe is behind us, and we didn't even get to the earnings numbers, and you think we're going to see a 7 to 8% earnings growth. Let's see what they deliver. Hopefully no shock and awe on the calls. That's Michael Purvis. Tol Balkan, Capital, our guest this morning on the markets, and we've got green on the screen for the moment.
Yeah, for the moment, and no surprise, but it's a slight move other than oil, right, which we are seeing still up about 1.9%. So we're up $1.38, 74.94 a barrel. But yeah, really quiet, no surprise. We all expected this. Having said that, you're looking at S&P 500 futures, 4808, the last print. It's up just, 0.07%. Call it little changed. I mean, that is our environment, and no surprise. So it gives us a moment. What I like about, days like today, it gives us a moment in a year where things were fast and furious, and the big narratives, the big stories, whether it was crypto, whether it was regional banks, whether it was Fed policy, like it could change and really consume us. The regional bank
crisis was a gut-wrenching, frightening moment for a lot of people who've never lived through the prospect of a bank. I know they weren't systemically important banks, but then look at the Credit Suisse UBS debacle.
Correct.
That was two systemically important banks. That was a crisis. But First Republic and those other banks were critically important moments in terms of the reality of risk, and those are called left tail risks.
I love that.
And I mean, with the benefit of hindsight, we can look back on that and say, okay, these weren't systemic banks that we were talking about. But remember, at the time, early March, there was a lot of questions about how far this would go. Are we looking towards a global financial crisis moment? Ultimately, we weren't, and the big got bigger. But there was, widespread agita there.
It's just the reminder that things can come up, nobody expects it, and then it's very significant. And I do wonder whether it's private credit, whether it's still commercial real estate. Is there something out there that we are potentially missing?
Well, there are defaults, not massive defaults on commercial property. The question is, how does that play out in 2024, and who's holding the biggest commercial property debt loads?
The exposure, right? The emperor wears no clothes. All of a sudden, wait a minute, what's going on here? All right, folks, we are watching markets. As we said, we continue to point that oil really kind of the standout market story today, up about 1.9%. We're talking retail. Got to talk it. Dana Telsey of Telsey Advisory Group on the holiday shopping season.
The day, though, consumers have been spending. As long as consumers have jobs, they will spend. Exactly how much they spend and with how much they lean into the holidays, etc., is certainly up in the air still, but they are spending.
All right, everybody, that is Julia Coronado. She's Macro Policy Perspectives President and founder, talking about the retail environment. You are listening and watching Bloomberg Surveillance. Carol Massar, along with Manus Cranny and Katie Greifeld. And retail, we've really seen as a broad group really outperforming this year, but not every retailer is the same.
That's the thing. A lot of idiosyncratic stories there. But I would say, I mean, really the story of the year, the past several years, you talk about consumer sentiment being in the gutter, but consumers have been so resilient. They're still spending. You have to think a lot of that comes back to the labor market. But how much juice is really left? How much pricing powers do companies have left, man?
Buy now, pay later.
Yeah.
There's lots of juice left.
When I was young, I had no aversion to buy now, pay later. Then I got stung by that. There's a wonderful line. Seriously.
Yeah.
I mean, there's a wonderful line from Paul Donovan. He's one of the chief economists over at UBS on the wealth side. And I am going to paraphrase here, which is never bet against, the avarice and the greed of the U.S. consumer.
Specifically U.S.
Well, that's why I'm paraphrasing. That's why I'm giving myself the caveat. The hedonism of the U.S. consumer. I will find the piece. There you go. The hedonism of the U.S. consumer.
All right, well, let's see what our next guest has to say, because she knows everything about the U.S. consumer. Dana Telsey is back with us, CEO and Chief Research Officer at Telsey Advisory Group. Dana, thank you so much. So appreciate you coming on with us again. The U.S. consumer, they do like to go out and shop, me included. How are we doing? What are we hearing about the day after Christmas shopping? Are you getting any early reads?
Yes, we just got an early read within the past hour. MasterCard Spending Pulse came out with their data from November 1st through December 24th. Holiday season sales up 3.1%, slightly below their forecast of 3.7%. And keep in mind, it goes through December 24th. Many of the other forecasters out there either go through December or through January. That's coming in at the lower end of the 3 to 5% range. But as you mentioned earlier, it's still up. Consumers are still spending. We've got gift cards that need to be redeemed. And overall, some of the interesting data that came out of it is the fact that apparel was up, online was stronger than in-store sales, jewelry was down, and restaurants that focus on experience, you saw restaurants and grocery being up.
Yeah, I'm just coming back from an overseas trip, and that's what I did. I ate out a lot and enjoyed it rather than shopping. But having said this, Dana, you're the expert. You've seen the cycles, coming off the pandemic. What do those numbers tell you about the health of the U.S. consumer?
I think the U.S. consumer is healthy. I think they're being very cautious in their spending. And the change that I've seen, even in the past year, we've seen a moderation in spending across all income levels. From high end to low end, that spending is moderated with much more cautious and discerning consumer. You think about some of the things that have changed. The luxury goods spend is lower than what it has been. You're seeing apparel being spend very discerning. Jewelry's been weak. It's expected that in 2024, jewelry will have more of an uplift, given we'll get back to more normalization in engagements post-COVID. But for the most part, it's very discerning spend, and the retailers planned appropriately. Discounts and promotions weren't as severe as they had been pre-pandemic.
Dana, good to see you this morning. It's interesting that the fresh data that you have is just a little bit lighter than perhaps the estimates. Give us your take in terms of hedonism, as UBS have called it. Never go short, the hedonism of the U.S. consumer. When you see credit card balances at over $1 trillion on a great proportion of buy now, pay later, is that hedonistic behavior that can cause us a problem in the near term? Or do you just look through it and go, actually, they're fully employed, we've got full employment, things are good, stop worrying about the credit card balances and the buy now, pay later?
I think overall, one of the things about the U.S. consumer, they continue to exhibit strength. I would have thought that as we went through this year, you would have had a greater moderation in spend from the lower and middle income. But exactly what you just mentioned is the strength of employment, inflation coming down, are giving them the ability to spend. They may not be spending as much as they did 2 years ago, given the stimulus that everyone benefited from, but they're still spending more than you may have thought. And now the lower rates, the stronger job market, that if you want a job, you can get a job, and that your wages are going up. And frankly, wage growth is pretty substantial with inflation easing. I think just the U.S. consumer is an optimistic consumer, even though the rate of spend is not as great as it was in 21 and even in 22 in many instances.
Dana, it's really interesting to hear you say that because, of course, one of the big questions has been how do you have the Fed hiking rates by 500 basis points without too much pain? And it sounds like when it's coming to that consumer spend, that can actually continue here, that actually maybe we did get through this tightening cycle without that sort of associated pain that was widely expected.
It does feel that way. I mean, you certainly have had categories that have been weak. You take a look at housing and things related to the home. That's been weak. You look at luxury goods, which has gotten weaker. But one of the data points to watch is, while year over year it could be weak, when you look back to 2019 to today, even luxury goods sales are up 50% plus. So that consumer, if they want a job, can get a job. But I think also one of the toughest things for retailers, we're seeing more confidence in their ability to project profits than sales. I think you're going to continue to see retailers being very cautious on sales growth. I think we don't have the tourism that we've had in the past, and that the orders that many of the wholesale accounts or department stores are placing continue to be cautious with vendors. I think that no one's expecting a rip-roaring retail environment go forward.
And I'm taking a look at the Telsey Advisory Group's 2024 top picks. I always appreciate a year ahead list. I want to talk about the consumer technology category. Your top pick there, you only have one, and it's Amazon. Who can stand up to Amazon at this point?
I mean, certainly what you're going to get from Amazon is your online choice. But when you're thinking about discounters, whether it's Target, whether it's Five Below, you take a look at Dollar Tree, look at off-price, where many of the off-pricers overall have had same-store sales of 5 to 6% plus. They're getting the benefit of the trade-down customer. So I'm watching in-store sales very carefully. Don't belie the fact that in-store sales continue to remain very important.
That's what I was going to ask you, because it's funny. I'm looking at Dollar Tree. They're down about 3%. I feel like there's been some struggling. When you know, not all retail is the same. Who do you think is most vulnerable in this environment, Dana?
I think when you're watching where the vulnerabilities are, it's some of the retailers overall who are too overloaded on inventory and who haven't innovated or don't have value. When you think about what we did for our 2024 outlook, who had the hallmarks of product newness, innovation, and value? In apparel and footwear, it's Birkenstock and Ralph Lauren. In off-price, you're going to get all the off-pricers winning, including Burlington and TJX. When I think about specialty retail out there, I think it's companies like Bath & Body Works and European Wax. And when you think about the discounters, like we mentioned, Five Below, Dollar Tree, and Target with their margin recovery story. But don't leave Walmart out. Walmart continues to be a share gainer, both with grocery and with goods.
Did you want to say something about Birkenstock, Katie?
I was going to say they're not the most aesthetically pleasing shoes. I'll just leave it at that.
Well, let's put it this way. Do you all find something very aesthetic?
You know, hey, listen, Barbie wore them.
That's
Pink
true.
Ones. Just going to say, Katie Greifeld.
That was after she left Barbie World, though.
Okay, so even better.
Yeah, that's true. That's true.
We've gone into Barbie World. Okay.
Dana, Telsey, I agree. Listen, the runways, right? They end up putting Birkenstocks, Crocs, like they go everywhere. Dana, Telsey, you're a gem of Telsey Advisory Group. Thank you so much. Happy holidays and Happy New Year to you. You know, I was looking at the S&P Composite 1500 Retailing Index. It's up 41% this year. I know it lops and drops a lot into that index, but nonetheless.
I mean, as Dana was saying, I mean, what a strange economic cycle this has been. You haven't seen that lower spend drop out in the way that was expected. Obviously, luxury has been resilient as well, just all over. It feels like this consumer, the hedonism of the U.S. consumer, it's unbreakable.
Listen, the hedonism of the rich is what you want to keep an eye on, because companies like Richemont, there's a very well-known Jan Rupert who runs it, hardy South African. And as he said, look, we're finding it harder to put through price rises. I had a couple of people here from the Middle East recently. They no longer pay business class, and the kid actually told the kitchen to cut the coffee capsules because they were too expensive. Billionaires and millionaires noticed the price of coffee.
The record rush to buy a Rolex or a Patek Philippe is over. That was a story on the Bloomberg.
I'm straight out there. I'm on the second hand. I'm there. I'm game. Get the bonus side, spend it.
All right, folks, we're going to move from retail broad out once again. Coming up next, Michael Landsberg of Landsberg, Bennett and Dubana. He is coming up next. This is Bloomberg on a pretty quiet Tuesday.
The signs are that the inflation dynamics have really exited that pandemic.
We can enjoy modest growth and disinflation, and it does suggest that the last mile may not be overly difficult.
You mentioned the phrase immaculate disinflation, and I think that's what we've had.
In terms of jobs cracking and inflation all of a sudden collapsing, it's not there in the data.
If I had to describe 2023, better than feared.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From our New York City, our global audience, a very good morning. It is Bloomberg Surveillance live on Bloomberg TV and Radio. Alongside the cohort for this week, it is Carol Massar and Katie Greifeld. This is not your normal surveillance.
No.
Are you calling us abnormal?
Well, you know,
I like a little abnormality.
You got to say, everybody needs a little bit of a break. So happy holidays to everybody out there and to the original cast of characters who I'm sure are tuned in. Not. Look, we've been here for 3 hours. Mm-hmm. The one thing that has moved progressively, incrementally, is the oil market. At one stage, it was up over 2%. This goes back to the top line of the story. It's about a changing dynamic of geopolitical risk in the Red Sea. The UK Navy reports 2 incidences on Tuesday on ships in the Red Sea. There are no injuries, but this puts forth on the table geopolitical risk, which has been underpriced in the oil market for a significant period of time. We've only been talking about supply and deficits, neither of which have had much of an impact. The deficits have not had the impact that the market and OPEC Plus wanted. We are talking geopolitical risk at the start of this week.
And you say it's been underpriced, that geopolitical risk. It feels like it hasn't been priced at all. Again, you bring us back to the conversation about supply. On the other side of that, demand really hasn't been there either. That comes back to the China story. We really haven't seen that demand coming from China. You think about the most bullish forecasts heading into this year, not panning out, to say the least, when it comes to oil. But, of course, seeing some real signs of life as we do get that geopolitical risk priced in.
I think it's really important and to try and figure out, where do we go from here, and does this continue to heighten? And it's just a reminder that things kind of, I feel like so often the conversations are like, well, that's a far from here. We're worried about inflation, jobs, labor here in the United States, and whether or not we continue those trends. But nonetheless, when you start to talk about supply chains, that is something that globally will impact things potentially dramatically. We don't want to get too ahead of ourselves. No. But nonetheless, it's now a little bit more higher on our radar.
Of course, and what OPEC Plus will do with the supply side of the equation, and we'll see how that pans out. Right? Or nothing at all. The Saudis are all in there in terms of the cuts. Quick snapshot of risk as we look across. If you're waking up this morning and you've had your 25th of December celebrations, equities have a little bit of green there. 8 weeks of a run higher on the board. We've had Wedbush Securities here this morning talking about get ready for a massive monster technology rally going through. Who will cut first and most aggressively will define the trajectory for the dollar. And of course, in tandem with that, euro-dollar trades at 110.15. The ECB could go first and perhaps a little bit more aggressively. We've had a debate this morning in the past 3 hours as to whether 160 basis points will be delivered by the Fed or not. Perhaps it's a little bit too effusive. Yields trade at 390 at the moment. You could have a little bit of a backup in yield as we are perhaps a little bit more aggressive. The market is more aggressive than what the Fed will actually deliver. And the oil market now, Carol, squarely above 2.25%. Let's bring that soupçon to Michael Landsberg, Chief Investment Officer at Landsberg Bennett Private Wealth Management. Good morning, Michael. I hope you were fully invested in the 60-40 portfolio and all is well with your clients. As you look at some of the performance in these equity markets year to date, there wasn't any other better trade than being just long the S&P. As you look into 2024, how much of the bullishness is fully priced in equities with 160 basis points of cuts assumed by the market? Good morning.
Good morning. I'm going to probably punt a little bit on the 160 basis points. I think that's wishful thinking by a lot of people on the street. But obviously, the S&P did well this year, concentrated in a few stocks. That has to broaden. It's not healthy for such a small amount of stocks to drive returns. Great that we own them, but realistically, we've got to look for other places to be able to generate returns. I think there's going to be not that 7 again. I think there's going to be a lot of variation in returns from those 7 in terms of what goes on. And I think the amount of cuts we're going to get is not going to be 160 basis points. I think that's that's kind of crazy to think we're going to get that kind of size cuts. And I think actually things in the Middle East are going to be interesting here as oil goes higher, inflation goes higher, and does that mean that potentially that they punt those cuts even longer?
There you go. The first man to say it's crazy to call 150, 160 basis points of cuts. So if we don't get those number of cuts, what does that do to the equity and to the tech equity narrative? Because to a certain extent, that outperformance by the NASDAQ is predicated in part by the collapse in yields. The NASDAQ 100 being up, if I extend my screen to the right size, there we go. No, we haven't got the right thing. I mean, it's up 40-odd%. I'll just double check on it. But to what extent is that outperformance going to continue in tech? 43.25% on the NASDAQ 100. We got there in the end.
I think part of what happened in this year was everybody got excited about AI, and a lot of things rallied just because they put AI in their speeches and in their earnings recordings. In reality, I think this is going to be a year to see who actually drives earnings based on AI. So I think there's going to be some stocks that do very well that have the AI story really embedded in their business and they're actually making money from it. I think it's not going to be a soundbite year where 2023, if you just said AI, your stocks seem to rally. I think it's going to have to be really shown this year to what that drives. I also think cybersecurity will continue to do well. As AI gets bigger and bigger, cybersecurity has to protect everybody from AI. So I think those sectors are going to do well. I think earnings at the end of the day are going to drive what tech does. It'd be nice to see the Fed do what the Fed does, but we're anticipating maybe 3 cuts not to happen until probably the summer, just given the fact that we're getting closer to the Fed's target, but we're not to the Fed's target. So it seems to me they were very deliberate with raising rates. I don't see them about facing right away and starting cutting rates next month.
That's what I find interesting, and I want to go back to that. You said, right, 3 cuts in 2024, but not until July. That's what you just said. So pushing it off, because the Fed wants to be convinced, right, before it starts cutting rates, that it truly has inflation in check.
Absolutely. And I think what I look would be, the only kind of fly in my ointment would be, if data comes out that's really awful, that we're heading into some type of a recession, a bigger recession, then maybe you get a cut earlier than that. But I think if things play out the way Powell wants, I think you're going to see a summer cut, maybe the July meeting, because that allows them to make sure that what they're doing is working, that we're continuing. Again, we're seeing oil tick up. Oil is a huge factor. And we know that even though inflation seems to be under control, Wall Street's cheering, the rest of Main Street isn't really cheering. I mean, Sentiment's awful. People aren't really happy. We saw that in the last segment. So I think they're going to want to wait to make sure they got it done before because cutting rates may increase inflation.
I'm not happy when I fill up the gas tank. My daughter's like, she's 20. She's like, why does everything cost so much? So I'm like, exactly. Having said that, I want to go to, do we need to see some kind of recession in order for some more of the fluff to come out of the economy and in order for new growth or new cyclical round of growth to start?
I think it depends on what you're going to define recession as. We've had, 3 or 4 negative earnings growth quarters for the S&P. I think it was 3. Apple's had 4 in a row of kind of negative earnings growth. So I think you're going to see what I would call rolling recessions. I don't think we're going to have this massive, recession because I think the labor market's good enough to not see that. But I think you're going to see some softness. There's some sectors that you want to avoid, and I think there's some sectors that you're going to want to be invested in with the idea that rates are starting to come down, maybe slower than people want. But I don't know if we're going to get the recession where everybody wants to run, and then now we go to the playbook. I think you're seeing these rolling recessions, with different sectors doing poorly in different environments, and I think that continues in 24.
And Michael, I'm taking a look at the 4th paragraph in the notes that you sent over to our producers. You say that the big themes for you, it's AI, it's cybersecurity, it's obesity. But if you're full bull, to steal a phrase from Manus, on those 3 themes, one of the things you can look at is buying Indian ETFs. That's really interesting to me. Of course, you think about this boom that we're seeing in India. That's been one of the big, maybe underappreciated stories of the last couple of years. Walk us through that call.
Well, and I think what happens is we're trying to find, besides obviously those big three themes that we're looking at, we look at those themes globally as well as domestically, is what are other areas of the world are having growth and not having a central bank raise rates to hurt them. So there's some of the emerging markets that we like, ex-China, but in particular, India's been our longest hold this year. We've held it most of the year. We think that continues to do well. GDP's at 7%. It's eclipsing China. And also, they're a capitalist economy. Let's be honest, the Chinese economy, not. We don't really know what they're going to do. The Indians are very much in line with kind of U.S. capitalist society, so business is doing well. We expect them to encourage business to do well. And we think you could own that kind of broadly with ETFs, both in the large cap and small cap space. Buying individual stocks, we do for our international portfolio, but oftentimes for most clients, having the exposure via ETF is kind of the smarter way to do it.
And Michael, we don't have a ton of time left, but you bring up China, and China has been a really interesting study over the past year. And we were talking about this a little bit earlier, that EM ex-China has really caught fire when it comes to investing overseas. Is that how you're approaching EM as well? Are you just kind of putting China to the side?
Absolutely. I think, the realization here is the Chinese economy is not a capitalist economy. They do things that are contrary to what we as investors want to see happen. And so why try to fight that and try to get things that are changed? Yes, obviously you can get excited about all the consumers and all the positive things that people talk about. But at the end of the day, the government's not on the side of the investor. And so we're looking for countries that are on the side of the investor, whether that be India, parts of Latin America, Brazil. We've liked South Africa. There's other areas that, again, we want to be able to invest alongside of governments that actually want the economies to grow, want stocks to go higher. We just think there's a cap to what you can make in China. And so the geopolitical risk there isn't really what we want. I'd rather be with countries that want us to make money and want their citizens to make money. And I just don't see that being with China.
Well, you're certainly alongside Goldman Sachs in your view that you now look at emerging markets, excluding China. Of course, Chinese equities down 13% this year, and that was the big bull call at the start of 2023. Where does China go in 2024 will be predicated on triple or cuts and indeed the level of stimulus, the quality of the stimulus that's brought to bear. Michael, thank you very much. In these last few days of 2023, Michael Landsberg there of Landsberg Bennett Private Wealth Management. A snapshot for you of risk. 4 days, you're probably not that interested in taking too much risk at this stage. S&P 500 up 0.1%. The market is assuming 6 rate cuts going into next year, an immaculate disinflation trade. The euro dollar, by the way, euro's up 3% so far this year. Is it capped out if the ECB goes more aggressively? Yields trade at 390 at the moment. Again, how far and how much pricing of rate cuts has come to bear in that bond market? I think it was Mohammed El-Arian's tweet of all tweets, which shows the sort of the parabolic move in yields higher. And then the drop. And that sort of is the personification of what this bond market has done.
Yeah, to put it in a really technical term, it looks like a roller coaster. You go up and then you go down. But guys, I've been dying to talk about gold.
She wants to talk about gold.
I really want to talk about gold. It's actually not moving too much this morning, up a hair or two, more so than the equity market. But I don't know if you missed this. I feel like we didn't talk about this a lot, at least on my programs. Gold
doesn't get much love lately.
I know. It hit a record high this month, though. And actually, we have a viewer writing in on Twitter or X, whatever you want to call it. Gold looks
I think
solid.
Elon probably wants it called X.
Okay, well, on X, someone writing in saying, gold looks solid this morning. Praise the yellow rock. And it has been a pretty good year for gold, even amid this bond roll.
So getting love from investors.
Exactly.
Even though it doesn't feel like in the narrative.
Yeah.
The kiss of death to anything is when you call your financial advisor and go, I'd like some ESG toast. I'd like some gold toast. It's
click.
Like, yeah, absolutely. Click, click, click. Okay, so let's see whether the immaculate disinflation does come to bear going into next year. Who will win the race for the IPO crown in 2024? The LSE
got chilly all of a sudden.
She got chills in her bones. We're going to talk to Sonali Basak, who are the winners and the losers in the IPO Flow show. We leave you with a hint of green for this holiday season.
Thing we're seeing is that deals are getting done. It's just taking a lot longer. With interest rates at least stable and probably going down, I think we're going to see more deals in a number of sectors and a number of geographies. I think we're going to see a lot of industries looking to invest in technology, and that's going to be expensive.
Frank Aquila there, Sullivan and Cromwell, Senior M&A Partner. If you're waking up this morning on the 26th after your holiday celebration, fear not. We've stabilized the markets for you. There's a hint of green on the equity narrative. We're up for 8 weeks in a row. It's going nowhere at the moment. Euro-dollar is flat at 110, 2022. Who will cut the most in 2024? That will define the trajectory of the dollar and then vicariously the euro. 10-year yields stand at 3.90. You have had this almost immaculate disinflation story and pivot party from the Fed coming to bear on the bond market. Let's just hope it stays that perfect pivot party going into 2024. Crude is racing ahead, up 2.72%. There have been strikes on ships in the Red Sea by the UK forces. We know that. And also there has been targeted strikes by the United States on very targeted strikes in Iraq. So these Red Sea incidences keep rising. There are no casualties. Brent advanced 3% last week. Angola's out of OPEC plus. And now you must look for deficits going into 2024.
I mean, if you're looking for an interesting trade, and we keep talking about this off air, it's what's going on with oil this morning. Just because as we move throughout the morning, the momentum to the upside has built. We're now up about 2.7%.
Yeah, it's been pretty amazing to watch it over the past 3 hours, just that move extending. And if you zoom out and you think about this big slide that we've seen in crude over the past couple months, think about what that has meant for the Federal Reserve. Of course, they strip it out in various ways, core, super core, but you think about how energy prices play into inflation expectations. And of course, the stability that we've seen in inflation expectations, a lot of that, I think, ties back to what we're seeing in energy, what we're seeing in gas, what we're seeing in oil.
In part, this energy complex is driven by a number of different things. One, the geopolitical tension, which to a certain extent was not priced into this market. There was almost an ignorance of what potentially could happen in the Red Sea, what potentially could happen by an expansion beyond borders, beyond the Israel-Hamas war. In other words, what would happen with Lebanon? We've just had a conversation this morning. The capacity of the Hezbollah in Lebanon, perhaps a little bit more limited, but these targeted strikes by the U.S. into Iraq, Carol, is about an extension of the conflagration for the United States of America, everything they didn't want.
Exactly.
And don't want.
No, exactly. They want to put an end to this, certainly, and they don't want to see escalation. I was thinking about the chart that we just showed up on television, in that it's pretty dramatic in terms of what we saw today. But again, it just feels like it's not out of control. It's not a 5% jump. It's not a 10% jump. So I think we're kind of waiting to see what happens next.
You've now put on 5.26% in the space of 6 trading days, which is 3% last week, which is more on a tightness in the market. And here we are. We deal with geopolitics this morning. From geopolitics to the land of plenty. What IPOs are going to be stellar in 2024? That is the question. Sonali Basak joins us around the desk. Good morning.
Good morning. Happy holidays.
Happy holidays. Holidays are over. I'm back.
Not yet. There's New Year's. There's New Year's.
Just say I've had enough chocolate to last me a lifetime now. The holidays are officially over. Right. The biggest IPO this year was ARM, and they chose not to perhaps have a little bit more of a UK lean because people are worried about that. What sector is going to be hot in 2024 for the IPO market? Good morning.
Good morning. And remember, ARM was supposed to really jolt back to life into the IPO market, and since then we had Instacart and Klaviyo. Instacart, Klaviyo, and a lot of the IPO hopefuls that really went public this year have not done that well. So how does that set you up into 2024? Because there is a hope for a rebound of the market, more stability in the market, rates stabilizing. However, there's a window. When you talk to bankers across the street, really Q1, Q2 is when you really have to see these listings start to hit the ground, and any uncertainty in the market, more geopolitical tensions, the U.S. elections toward the end of the year. There's so much uncertainty that recognition of the window might make it tough for a real revival in a massive way of the IPO market.
Let's name some names here who might take advantage of that window. I know that Reddit has been reported to be thinking about it, and Kim Kardashian's Skims. Tell us about that.
Yeah, and there's some hot names like that. Reddit, Skims, these are recognizable names. And others like Syngenta or CVC as well have been rumored to have thought about an IPO early next year. They are obviously considering it. Some of these names have considered it for a long time. But here's the thing. And by the way, not just that. There's a lot of private equity-backed firms, too. A lot of private equity companies need that liquidity, so they might seek to bring portfolio companies to market as well. What is the investor demand? If there there's not enough demand at the end of the day to meet these companies to go public. And remember, they also may have to swallow a valuation discount into public markets next year. It's kind of complicated calculus when you think about the setup for what we're going to enter.
Well, go into the private credit side of things, because I find that fascinating. And we've talked about this over the last few years, that there's so much money in the private world that companies that used to go public much sooner can stick around for 10 years because the money is there. Is that still happening?
Private credit will get you into part of the capital equation here. It can help people raise capital to kind of make it through this side of the storm, but we're no longer in a storm, right? People are looking to go public. People like to have that stock to pay employees, to make acquisitions. There are reasons to go public, but here's the problem. If you're a private equity-backed company and you're already levered up, will a public investor want to get into that capital stack now?
Right.
There's a bigger demand for profitability, a bigger demand for a better balance sheet going into these markets. Limited partners of private equity firms are finally demanding exits. They're demanding returns. And so what I've heard in the market is that even the private equity firms are willing to take haircuts in terms of valuation to get those companies to public markets
to
or
get
in
them
a
through,
sale.
right?
To get money back to investors.
Sonali, is there one company in particular that you feel like we have to watch it? It's going to be the one that's going to kind of set the tone?
It's not like this past year where we had ARM. That was such a giant listing. I think one thing to watch for that's a big question mark is not just the American companies like Reddit, like Skims, the exciting names. It's whether you also see other international companies based in China looking to list in the United States, for example, given those geopolitical tensions, given worries about even how China is approaching their own technology giants. That is a big question mark among bankers across Wall Street today.
I'm going to throw a gambit out there. Hopefully she's read this.
He's had his coffee now.
I'm excited now. Of course, I've just arrived here from the Middle East, and that's where the bulwark. I mean, the only place you earned money as an investment banker was in fees in the Middle East, and they did $10.5 billion of IPOs this year. 45% of the volume globally got done there. I just wonder, can that endure into 2024? I mean, they've still got a very, very ambitious agenda.
And that's nothing to say of all the money that is going into private hands from the Middle East, Saudi Arabia.
And they do heck of a deal with KKR and different people like that on the utilities.
Absolutely. So do you go public, whether it's in the Middle East, London, or New York, or do you take money from Saudi Arabia next year as they're looking to deploy and diversify?
It's a very interesting sort of political issue potentially for capital markets. Who do you back? Which sovereign wealth funds and which equity backers are you going to take money from, given the geopolitical status at the moment?
Yeah, and you and I have talked about this on the sidelines a lot. The Middle East has held on very strong to their base of privately held companies, venture capital firms, private equity firms. Money has been drying up across the board. U.S. pension funds. Think about how distracted, for example, CalPERS alone is these days. The Middle East has still been the place to go, and there's no sign of that letting up into next year.
Yeah, well, a great deal of this, of course, will come down to the de-escalation of the Hamas-Israel war. Good to see you. I think it's the first time we've actually been on air together for a full conversation. So
it's always a good morning when we get Sonali on.
Yeah.
Always.
I'll be back tomorrow, I heard.
Good morning coming.
A ray of financial sunshine. Sonali, we'll see you tomorrow morning. Come prepared, as always. Shall we have a snapshot of risk? It's the 26th of December. It's a different triptych that's in charge of the bus this morning, driving the car, changing the gears at the same time. Look at that. We're delivering a magnificent, resplendent green for equities. 0.9% up on the S&P 500. Wow.
Yeah. Maybe this is why Elon Musk doesn't like public markets.
Maybe not. There's
it's kind of mellow.
Exactly. Talk about wow, though. Crude, that move extending. We're getting close to 3% higher on the day.
Yeah, added together, that gives you 6%. And the spreads, the near-term spreads have tightened. So there's a double assumption there, geopolitical risk and potentially deficits into the first quarter of 2024. Coming up with your new surveillance lineup for a couple of days, it is Will Smith of AllianceBernstein joining us. Oh, it's foggy outside. Look at that. Grey and dull. Not like that in here. This is a special edition of Bloomberg Surveillance alongside Massar and Katie Greifeld. Good morning, I'm Manus Cranny. We're moments away from the start of the cash trading. These are the futures, by the way. You've had the longest winning streak since 2017. Do you really want to put money and deploy money? There is the opening bell. Do you really want to deploy money into these markets in these 4 days, or do you want to be a little bit more convicted by what goes on? Home prices extending towards records, so you are seeing the consumer spending holding up, but just a little bit lighter on the MasterCard survey than we had anticipated. Across the assets this morning, yields have been prevaricating around the 390 level. The market assumes or presumes, or its probability of rate cuts from the Fed of 160 basis points. Euro-dollar trades at 110. That is up 1/8 of 1%. Who will cut more aggressively and faster? Will it be the ECB or the Fed? Who's got more work to do on the rate cutting front? And crude is the exponential mover, up 2.73% at the moment, Carol. That's been on the move for the past 3 hours.
In a morning that's the markets have been really kind of mellow, to say the least. Little change. That is certainly one part of the trading world that has certainly stood out, and that has to do with increased tensions in the Middle East, specifically what the U.S. has done in terms of attacks in Iraq, specifically taking out some facilities, and that has certainly increased the concern, right, Katie, in terms of does this spread even further? And that has been the nervousness from day one of this.
I will say, even though we are seeing this move, this dramatic move in crude so far this morning, it hasn't bled over into the cross-asset picture. You think about equities where treasuries are trading at the moment. Of course, we'll see if that changes.
Indeed. But let's talk about some of the deals that are on the slate, even though it may, in theory, be 4 days of quietness. We're here, Simone Foxman alongside me. It's been a while, Simone. How are you doing?
Good, Manus.
Intel, they're taking $25 billion off of a new move, of a total of $25 billion in Israel, and they've got incentives. This is Israel trying to sort of re-secure its destination as that tech hub.
That's right. And yeah, right back to the Middle East for us.
Straight back home.
Yeah, this is a $25 billion chip plant that Intel is building in Israel. We knew that the company was going to do this, but we didn't know the incentive package that was likely here because Israel had announced this deal back in June. But we now know that it's $3.2 billion. This entails Intel spending $16.5 billion with Israeli suppliers over the next 10 years. This is a factory that will have to do with wafer fabrication. Intel already incredibly important to the Israeli economy, employing almost 12,000 workers across the country, and last year accounting for 1.75% of the country's total exports, about 5.5% of its tech exports. So just expanding there, the Pat Gelsinger, the CEO, on an aggressive campaign of expansion to try and build up its technology capability, and that is an interesting one for us this morning.
Okay, and just one other deal on the slate there. You've got Miss Bristol Myers Squibb. Just give us the top line detail on that.
Yeah, Bristol Myers Squibb buying Raise Bio. This is a company that specializes in radioactive therapies, so targeting specific tissues in specific organs for cancer and not damaging the outside tissues. This is an increasing area of interest for a lot of the big players in the pharma space, Novartis, Eli Lilly in this. Truist says this is a really good deal for Raise Bio, and we can see that reflected in the share price this morning. But the transaction expected to close in the first half of next year, and Truist says, this investment kind of de-risks the overall radioactive drug space.
Okay, Simone, thank you very much for those updates. The stocks are trading and live. Let's bring in our guest, Will Smith, Director of U.S. High Yield and Credit at AllianceBernstein. So there is this narrative of immaculate disinflation, soft landing, etc. We've got all of those cliches. I'm drawn to your observation about allocation. Investors are way underallocated to fixed income and credit generally. So with the compression that we've seen in yields and spreads, what happens in 2024? Do you think that there is a major additional allocation of capital to credit and to fixed income? Good morning.
Good morning and happy holidays. Thanks for having me. So yes, we think there is potentially a very big rotation trade that can and should happen next year and maybe into the next few years. And that is that over the last decade, yields have been so compressed within fixed income that investors have rightfully so moved more capital into equities and into private markets, and more recently have moved a lot of capital into money market instruments. And when we look at some of the recent moves in yields and spreads, we think the market is really starting to anticipate some of this rotation. And if you look at an instrument like the money market space, there's about $6 trillion that are sitting in those investment vehicles. And as rates start to move lower, which we think they will, investors will have to reallocate that capital elsewhere. And we think fixed income is the area that over a longer term horizon looks quite underinvested from an investment perspective.
I mean, that's quite a conviction call. Naturally, of course, it is your book, it is your world. But what is it that makes you believe that bonds and credit will win the war against equity in that flow narrative from the money market world, from that $6 trillion in money markets? Because institutions also have money in there as well. So what is it that makes you think that they will trump versus equity?
I think it's two things that are really important. One is the starting point. Investors have a lot of equities in their portfolio today. So when you look at the balance of those portfolios, it looks quite unbalanced to us because you have a large allocation to equities and then you have a large allocation to money market funds. So you don't have that kind of ballast in the portfolio that you'd like to see, things that will make you money if risk assets sell off. And that's what bonds do, and that's what they have done historically. And we think that they can, from here, continue to do that because the levels of yield are so much higher. So that's the first reason. The second reason, and this is more from a credit perspective, is we think investors should align themselves closer to cash flows. And what we mean by that is because yields are so much higher, companies have to pay a whole lot more of their cash flow to creditors, which means as a creditor yourself, you're benefiting from those higher rates and the cash flow really being diverted from shareholders to bondholders. So we think that's a really important dynamic, and we think investors are starting to really grab hold of that narrative and like this idea of aligning more with cash flows and less with, say, residual returns, which is essentially what a stock investment is.
Will, I get your environment, but I want to push and kind of build on what Manus said. I mean, a lower rate environment sounds a recession. Won't that really, though, be a great environment for riskier investments?
It might be. Now, the context really matters because if we look at what happened, say, last year, the Fed and central banks around the globe hiked rates a whole lot more than the market anticipated, and that was actually really good for credit. While it's easy to say that Fed cuts or central bank cuts is also really good, we think that might be a little bit misleading because if the Fed were to go out and cut rates, say, 6, 7, 8 times next year, which you think is aggressive, that's probably in the backdrop of an economy that's softening a lot. So I think the context really matters, and we'd prefer to see the Fed and central banks cut just a few times next year because inflation's come down, and that's more because growth has held up well, which is much more important to us for risk assets.
Yeah, the why here behind these rate cuts, they really matter for 2024. Let's talk about the Fed a little bit more and how the Fed relates to the high yield credit market. I thought this line in your note was really interesting, that the maturity wall risk, it's overstated generally, but a subset of the credit markets needs a much more significant rate rally to work. Mm-hmm. Talk to us a little bit about that. Which sections of the credit market are you referring to?
Yeah, Kate, there's a staggering amount of debt that needs to get refinanced over the next 3 years. We've never had this much debt that needs to get refinanced in such a short time period. But the vast majority of that debt is really about price, meaning companies have access to capital. They could refinance that debt, but they're waiting for prices essentially to come down. And so far, they've been right to wait. Now, there is a percentage of that maturity wall, if you will, that are within companies that don't have access to capital. That's a lot more problematic. And the reason they don't have access to capital is because their balance sheets were constructed in a very different environment, an environment where rates were incredibly low, near zero, and expected to stay low. So there's a lot of debt put on these businesses. And we see more of this actually in the loan market and in the private credit markets than we do in the bond space. Mm-hmm. Those two markets have actually seen the majority of that kind of aggressive issuance that came out of, say, the COVID time period. So those are the businesses and the areas of markets that we're more concerned about. And quite simply, those balance sheets just do not work with borrowing costs that are significantly higher than zero.
Right.
So those companies really need to restructure their debt levels.
Okay, so refinancing risk, it's still out there and it's still real. You brought up private credit, and I'm glad you did, because a guest on this program last week, unfortunately I can't remember who, made the point that the high yield market in the US has gotten a lot healthier, a lot less risky, because some of the problem childs in the public high yield market have gone into the private markets. Weigh in. Does that thesis hold water with you?
It certainly does. One really simple way to look at this is the size of the CCC universe in the high yield bond space. Today, it's about 12% of the high yield bond market. Historically, it's more like 17 or 18%. If you go back to the great financial crisis, it was 21 or 22%. And that's because there was a lot of private equity activity. Those LBOs were financed in the bond market, and today that hasn't happened. All of those private equity firms, or most of them, are moving to private credit as the answer to raise their capital. And the CCC space really has shrunk over the last 5 to 6 years as that capital has moved into those other markets. So it's a very different high yield bond space today than it has been historically, and the most aggressive issuance has happened outside of our space.
Just briefly, we often talk about king dollar, US exceptionalism, et cetera. When you look at the credit markets, are there going to be greater opportunities for you outside of the United States of America in the credit sphere, or is it going to be king US for you?
We think it's pretty balanced. European credit, from a valuation perspective, looks a little bit cheap, but we think it's cheap for a reason, which is the economy is weaker there and more likely to run into some growth issues next year. But that being said, we're always finding some good credit opportunities outside of the US, in Europe and in Asia and India, et cetera. So we think building diversified portfolios is the key, and you can always find some really good opportunities outside the US.
Well, thank you very much. Let's see who cuts first and fastest going into 2024, and what level of slowdown do we have in the UK and Europe that may define the ex-USA trade. A snapshot on the 26th of December of how the markets are looking at the moment. The S&P 500 trades at 47.66. That is up 0.24%. So you're looking at one of the, I mean, we're a whisker away from our all-time high.
Significant, right? If you think about what we've been through over the last 12 months.
If you think of the next 3 months, it's how much, and guest after guest after guest, if it's on credit, if it's on bonds, if it's on equities, to what extent does the maturity wall in your CD impact the flow show from those money market funds back into equity and back into credit and back into bonds?
You know, it was nice to get sort of a refresher from Will Smith that, of course, refinancing risk, it's still out there. Even if rates do come down, you think about some of the weaker balance sheets out there, they're still going to have to deal with that. It has been, to your point, really interesting to hear guest after guest talk about this broadening out of the rally, because at least for the first 9 months of 2023, everyone was telling me this is an up in quality world. That's where you want to say. Now it feels like people are a little bit more comfortable out the risk spectrum.
Yeah, it definitely feels that way. And that's certainly been the trend and the momentum of the last couple of weeks or month or so. But it is interesting when you've got to tap the debt markets as a company, what you can do at 3%, 4%, 5% versus 10, 12. It's a very different equation.
And the patience, perhaps, of well, I say patience, but private credit investors can perhaps be a little bit more focused on you rather than just patient.
Right, but we heard from Shanali that people, right, private equity wants an exit. They've got a timetable as well, so plays into it.
The deal sheet may pile up, and therefore the bonuses may look sweeter in 2024. Coming up, we're going to catch up with Charlie Rose of Invesco Real Estate. Are you full bull on real estate in 2024 or nervous?
The bear story, it's valuation, it's China, and I think at that point it's a headwind, but it's more fictional Netflix story than reality that's going to hurt them. And then it's just more competition, but it comes down to valuation, and that's why this year I think the bears, they focus so much on valuation instead of the actual underlying growth story that's happening not just for Apple, but we believe it's the start of a new tech bull market for tech.
Dan Ives, the senior equity analyst over at Wedbush. You're going to have a Damascene moment in technology like you haven't seen since 1995. Where were you in 1995? And did you have a Bloomberg terminal? I did. And he is talking about technology. Apple's going to be worth $4 trillion. Let's have a look at the markets. This is the state of play as we go into the first post-holiday trading day. S&P 500 up 0.25%. You're looking at yields ticking up ever so slightly, but you know this is going to be a thin liquidity market. What's your fact of the day? 1969. I love Carol Massar. She's got the fact of the day. In 1969, the S&P 500 has averaged a gain of 1.3% in the 7-day period during these holidays.
You don't mess around with Santa Claus. I'm just going to say, you know.
Santa Claus coming to
I
town.
just think, you know, there's this FOMO, fear of missing out. Like, I just think people have been jumping on, and maybe we just feel like we have finally some clarity from the Federal Reserve in terms of what they are planning to do, and maybe some expectations for 2024 that, yes, indeed, there's a gamut in terms of are they really aggressive or are they just a little bit aggressive, Katie?
Well, I think the question becomes in 2024, okay, we have clarity. Did investors take it too far? 150, 160 basis points of cuts priced in. It feels like that is setting
there's
up.
Pivot and then there's pivot.
Yeah, right. Just totally doing away with the notion of higher for longer. Now it's higher and then cut in March.
Yeah, I mean, look, we're going to come out
July,
with,
as one of our guests said.
Yeah, we're going to come out with a lot of cliches. You know, is this irrational exuberance? Is this correct exuberance predicated on the rate cuts? We're going to debate that, I would say, a lot in 2024. We're also going to debate what's going to happen in the real estate market, commercial real estate market as well, and whether...
Finally, does it come undone?
Well, that's the question.
Or not?
I think there's been a few quiet defaults that we haven't really made enough of. Let's ask Charlie Rose, head of real estate and credits portfolio manager at Invesco Real Estate. Charlie, good to see you. You know, we've talked about a quiet recession. We've talked about a slow burn recession. I just wonder, give us your perspective on the defaults that we've seen in 2023 in commercial real estate. Have we underreported? Have we underassumed what's going on in commercial real estate? Set the stage as we go into 2024. Good morning.
Sure. Well, to go into the cliches, I do think Santa brought a gift for commercial real estate this year, and that is that Fed pivot. It is the first step that we've been looking towards for there to be normalization in commercial real estate values. Within the real estate credit markets, we saw much more discipline this cycle as compared to the years leading up to the global financial crisis. So overall, delinquencies remain moderate, in fact, well below what we saw in 2020 during the COVID lockdowns, and less than half of what we saw during the global financial crisis.
And yet, Charlie, you know, you walk around Manhattan, you walk around different major cities, and you still see a lot of vacant properties, commercial properties. And having said that, let me roll one more thing. Just a few days ago, Brookfield Property, their issuer credit rating was cut to junk, put on a negative outlook by S&P Global Ratings. The real estate investors' credit quality deteriorating amid those higher borrowing costs and weak office demand. Brookfield, not a small player, well-known player, global player. So when that happens, how do you cross that with like, wait a minute, shouldn't we be a little bit more concerned about commercial property, as we have been talking about, but should we still continue to be talking about those concerns?
Yeah, absolutely. So commercial real estate values in the aggregate are down, depending on the data set that you look at, right around 20%. But there's a lot of variation within that. Commercial real estate cannot be painted with one broad brush. You have the office sector, which is about 20% of the sector overall. Now, within our portfolio, it's much lower, right around 7%. Commercial office has experienced much more weakness. We're seeing relative strength in the industrial sector, still strong positive rent growth in that sector, strong fundamental demand, still positive rent growth in the multifamily sector, along with a long-standing undersupply of housing. So you really have to get under the hood and look property type by property type.
Well, so location, type versus, type. You've got to be smart about it. But I'm looking at U.S. office prices down about 35%. Malls have dropped 20% since peaking in the first quarter of 2022. This is some data out from Green Street, which is a real estate analytics firm. So having said that, commercial office properties, is there something that we are missing? A lot of people come on and say remote, work, that is staying with us. We may not feel it here in a lot of New York offices, but it's going to stay, and that's going to have an impact.
Yeah, so our focus really is on the multifamily and industrial sectors where we are seeing that strength and which today are the largest two property types within commercial real estate. Office, I tend to compare to the mall sector and that 10+ year burn that we saw. They're great performing malls. Visit Westfield Century City here just west of Beverly Hills. And sales are at record high levels there. And we've actually seen some real strength in retail over the last year. Office will come back, but it will be the best performing assets. In the meantime, there's plenty for us to do in other asset classes.
And Charlie, I don't need to tell you that a conversation about commercial real estate in March, in April, would sound a lot different than the conversation that we're having right now. A ton of doom and gloom about commercial real estate after what we saw in the banking system in March. And in your notes, you point out that 32% of all CRE lenders have exited the market over the last year. Is that just banks pulling back?
Yeah, so let's set it up. Commercial real estate debt, $5.8 trillion asset class, making it the fourth largest fixed income asset class in the U.S. 51% of commercial real estate loans are held by banks. Banks have pulled back sharply, over 70% pullback in their originations volume this year. And that has been the single largest driver in a reduction in loan supply in the market. But we've seen other lenders pull back significantly as well, driving that 32% reduction in active lender profile. The mortgage REITs are largely effectively out of the market, and the agencies have pulled back on their underwriting standards as well. So we're seeing this large asset class with a record high level of maturities over the next couple of years, meeting very low supply from the traditional participants in the market.
And Charlie, what's the risk here? You talked a little bit about office, some parallels there to what we've seen with malls, but from an industry-wide, a CRE-wide perspective, what still keeps you up at night?
Certainly, we've seen really strong fundamentals across the industry, with the exception of office for the last several years. As the consumer weakens, and as we have some supply coming on the multifamily side, we have seen a tempering of that growth. Multifamily rent growth has gone from that 15 to 20% range coming out of the lockdowns to about positive 1% and has turned negative in some markets. So that really is why we as a firm are focused primarily on the credit space, given the deep insulation that we can get in the credit space, combined with elevated base rates and spreads 100 bips wide of normal.
Charlie, we sat down with Mr. Schwartzman. He's a buyer of deals. He says the deals, mothballs, will be taken off in Europe. He sees opportunities there. He's like you. He likes data centers, warehouses, and some housing. Briefly, how do you see Europe? Are you dovetailing Schwartzman? Or are you ahead of him?
We're active in Europe. Commercial real estate markets in Europe are much less liquid than they are here in the U.S., much less information available in the market, and we actually saw values reset more quickly. So the growth picture is certainly weaker in Europe, but there are values to be had, and it's simply a much less competitive market, driving higher spreads in that market.
Charlie, thank you very much for being with us, setting the stage for 2024 and beyond on the real estate. Charlie Rose at Invesco Real Estate. We'll close off with a quick look at risk, ladies. We got there. We changed the gears. We steered the car. Nobody fell off.
Nobody got hurt.
We got extra coffee. How does risk look? There you go. A little bit of green on the screen. Up 0.2% on S&P 500. The run is not done.
Nope. We got what? 4 more days?
4 more days.
Four more days together,
Three
ladies.
more days.
There we go.
3 more days.
Right.
All right, stick around. Bloomberg Markets is coming up. Saren Kunst of Clio Capital. She'll join the team. This is Bloomberg.